crypto DeFi, for example. And I would say that's definitely going to be increasingly a more important part. Like, how do we make our process more efficient? How do we reduce credit risk and things like this that I mentioned just before?
So you've mentioned the reasons why this matters and why institutions are interested in increasingly tokenizing real-world assets. But what's stopping them? Like, what are the hurdles to get there?
Yeah. I'll start by saying, like, look, there's still, there's a couple of them, and I touched a little bit. Let's just, summarize it more clearly again. So number one, I would say, is lack of clear regulations, but also lack of harmonization across different geographies of regulations around securities laws and so forth. Then there's one definitely around, like, the fragmentation of liquidity and interoperability of these networks. If we, as an industry, crypto industry, I mean now, don't want to recreate the same problems that exist in the legacy financial market infrastructure around fragmentation, we need to build more seamless bridges around, like, aspects like security, et cetera. And I think there's a lot of work there happening, and we will see, continue to see improvements. And then, user safety, goes alongside that around, like, hey, blockchains have this inherent feature around transparency, which is great. But, in order to keep users safe, there needs to be a good degree of, like, privacy as well. And so I think cryptographic developments around things like zero knowledge proof are super interesting, which we are also spending research on, and see how we can integrate these elements into the XRP Ledger, which we work with.
Okay, and that's a good segue to...
Can I just say...
Oh, of course.
I think it's also important to not just, frame this as, oh my God, there's so many hurdles in the way. I do firmly believe in terms of market readiness, in terms of, like, blockchain technology developments and industry evolutions, we are at the point where we can deliver proof points why why the financial industry should care about blockchain technology. And it's up to us to deliver these proof points and showcase what this technology can do today to solve for real-world financial friction and problems. And frankly, this is what we've been doing at Ripple since day one, with insertion point around payments, facilitating billions of dollars of real-world payments using crypto nowadays. And obviously we're looking to expand that into other use cases, including enabling by tokenization.
Yeah, I think that's a common theme across the industry. The industry has spent all these past years just building and building infrastructure. I think we're finally at a point where there's scalability, there's in privacy, there is a sense of more of regulatory friendly environment. All these things that were stopping mainstream use cases from taking off in the past. Feel like now getting closer to becoming resolved, and obviously tokenization is a big part of that. So totally agree. Speaking of what Ripple has been doing, would love to wrap up by hearing more specifics on your roadmap. I know you recently announced institutional DeFi plan. So how do you see Ripple fitting into kind of tokenization future?
All right. 2 minutes for this. I'll unpack it in two elements. So the area I look after at Ripple X is basically brings together all of Ripple's contributions to the layer one blockchain, the XRP Ledger, and you highlighted the institutional DeFi roadmap that we're pursuing there. So it's basically we have a group of product engineering people who contribute with new financial primitives, compliance features onto the XRP Ledger, so it can really be a backbone to power this transformation, bring more of traditional markets on chain. What I also know is that since day one, the XRP Ledger came with inherent features that support institutional DeFi. So it's the first blockchain that had a native decentralized exchange integrated on the protocol level. It's the first blockchain that allowed tokenization, IOU back then when nobody even knew about about the word tokenization. And we've added features over time, like client fee callbacks, decentralized identity, an AMM has been introduced this year, and this year we'll continue to add new primitives like a lending protocol natively, and we're also aiming to bring programmability and more business logic for financial applications to the XRP ledger. And then the second piece is really Ripple at large. And so, we used to be really recognized predominant payments company, and I would say Velocity has really evolved into kind of like this one-stop shop for digital asset infrastructure. So we have a Ripple custody product, and another foundation enabling tokenization. We have our contribution to the XRP ledger that I alluded to. The flagship payments product. We also launched our own stablecoin, and our partner around like stablecoin issuance on the XRP ledger. And so brings together kind of like the ability to not only a partner for RWA to really be able to kind of like provide a whole ecosystem for financial locations into that space. So pretty excited for what's ahead.
Yeah, exciting times for Ripple. I think we should definitely at least kind of give a shout out to the SEC dropping the case against Ripple, so that just opens up, just frees you up to pursue this roadmap without the way of this kind of regulatory risk hanging on. I think that's worth highlighting.
Thank you for saying that. Appreciate it.
Okay, well, Marcus, thank you so much for sharing with us, and thank you all for joining.
Thank you all for tuning in.
Welcome to the stage, Casey Wagner, Pfizer, Dimitrov, and Kirti Modgal.
I'm Casey Wagner. I cover policy and regulation at Blockworks. I'm very excited for this panel. We are going to be talking about digital asset innovation, banking. I have Kirti, who's the head of products at Nexus Digital Assets at JP Morgan. And I have Beezer, who is the head of digital asset technology at Citibank. Thank you guys.
Thanks for having us.
So when they told me I was doing this panel on crypto banking, the first place my mind went was tokenization. I feel like that's a huge topic, not only at this conference, but really I know the last panel was as well. Kirti, maybe we can start with you. Kind of give us like a general overview of how traditional banks are thinking about tokenization right now, both in terms of traditional assets, but also more alternative assets.
Yeah, for sure. I think even outside of like our bank, I think in general, when about tokenization, they think about three things. The first is efficiency. So how can we make it more efficient for assets to move from one party to the next? The second is utility. So once you have a more efficient system, what can you actually use those assets for? And I think the third, which we've definitely seen more in the public space and less so in our own efforts, is about distribution. So once you make it more easy to move things to the next, and you make it more useful, or you introduce utilities that you didn't necessarily have before, can you access a broader reach potential clients and investors. So from the JP Morgan perspective, as I mentioned, definitely focused our efforts around the first two. So taking a look at our different business lines and understanding where are their problem statements for which implementation of technology could really allow us to create more efficient settlement systems. So for instance, one of the applications that we have live on our platform, we've had live for the last 4 years. I think it's nearing around 2 trillion total volume traded. Has been entirely around the concept of tokenizing traditional assets. So think of your treasuries, your mortgage-backed securities, fixed income assets, and enabling our clients to use that to access intraday lending, which otherwise in the traditional ecosystems might be a little bit harder to coordinate orchestrate. We've since expanded to other forms of utilities, so for instance, tokenizing market funds, using collateral. And as we continue to think about tokenization, it really comes down to those first two themes, right? Looking across all of the different asset classes that we serve, where are there efficiencies that we can introduce, and then what sort of new markets and new products can we create on top of that.
And I love that you mentioned infrastructure. I definitely want to get into that. Advisor, I'm curious to hear your take on the current landscape of tokenization you guys are working on.
First, thanks for having me. Tokenization is a big topic for us as well. It's on top of all the benefits that Kirti mentioned. We see it as an enabler for efficiency and creating different forms of traditional assets, representing them on the blockchain. And safe to say that tokenization is probably the first product market fit usage of blockchain rails, because we can automate through smart contracts, different primitives, we can automate activities, tokenize assets, and drive benefits from representing them on the same ledger, on a single ledger, with sufficient efficiency, auditability, with all the benefits that blockchain digital asset brings. So what we're excited about, and we've been publicly announced in the last few years, is token services for cash. That's a tokenized solution where we tokenize city commercial bank money, and we seamlessly move within city branches that are onboarded onto this network. Additionally, we are thinking about tokenizing different types of agreements. So think of it as within the trade finance use cases around IOUs and letters of credit, bill of exchange. So these type of codified smart contracts where you tokenize an agreement, a promise to pay on delivery of specific goods or specific agreement. So that's a separate angle of tokenizing money, payments, assets, but also tokenizing agreements, which are traditionally paper-based solutions. So we can drive efficiency from the fast rail, the 24/7 on-chain rail, but having smart contracts with them to actually seamlessly settle, execute. It's a if this then statements of moving promises and agreements and settling on the same ledger.
Yeah, definitely. I like that you both mentioned tokenization as a way to improve efficiency. You both mentioned some really interesting utility cases. I'm curious, kind of moving beyond tokenization of traditional assets. Kirti, you mentioned alternative assets and kind of moving into that space. I'm not sure how much you can share about what JP Morgan is working on specifically, but I am curious what you can share about the banking system thinking about tokenizing these alternative assets.
Yeah, for sure. I mean, I think the focus, like as you can probably hear it from what both Visor and I have said, like the focus, and what you can also Google and see that the industries are doing. The focus for the last few years has definitely been around bringing the more traditional, more liquid assets on chain, because you need forms of on-chain cash. You need forms of, like high quality liquid assets on chain in order to get people comfortable with having an asset for which they use to purchase maybe more complex or alternative assets, and be able to drive efficiencies on the settlement layer for those assets by having that form of on-chain cash that allows for DVP. So it's definitely been, I think from like going back like a few years, I think the first types of tokenization use cases that this industry actually tried were all around alternative assets, and the thought way back when was like, okay, if you can make it easier for someone to like settle the thing, does that make more people want to buy it? And we very quickly realized that that wasn't necessarily the case with like buildings or private equity funds or whatever. But now that we are starting to have a few more of these like, I guess like primitives, either stablecoins, deposit tokens, or other forms of on-chain cash, or tokenized funds on-chain that are getting people a little bit more comfortable with the infrastructure and comfortable with sort of like how to interact with the technology, I think we, along with our peers, can start to think about like what are those more complex asset classes, and maybe take a slightly different approach this time in terms of how we'd think about tokenization, right? Like, is it around just tokenizing the thing and saying people will come, or is it actually around finding the access points, making the lives of like an access point or a distributor a lot easier, and through the use of tokenization, and then therefore driving more sort of like interest in the asset classes.
Just to add on the topic, we've done experiments in the past with different types of smart contracts, different types of assets, but essentially focusing on creating, let's say, money market fund or basket of securities within tests that we have experimented with different ledgers, with different networks, but essentially rethinking how we could be utilizing the promise of the smart contracts and adding metadata to it. So, for example, the added benefit of this ledger is that you can have also decentralized IDs on the same ledger. You can have privacy-preserving techniques like zero-knowledge proof on the same ledger. So this way you can codify, for example, the accredited investor certification within his wallet, so he instantly would be able to buy a money market fund or specific security without having a separate KYC check. So this type of thinking, this type of efficiency can drive a lot of simplification, reduce errors, reduce risk, and overall make the ecosystem healthier. But something I would like to caution on as we are thinking of what kind of assets we should or could be tokenized. I know a lot of industry media have come up with numbers around what is the target addressable market for tokenization, and you can see different numbers, but I'm not sure if everything that could be tokenized would be tokenized, because as Kirti said, even if you tokenize it, is there sufficient demand for it? If there is sufficient liquidity, who would buy it? Just because it's on a blockchain, does it make it more interesting? So outside of driving the efficiency, reducing risk, and making the whole process for issuers, authorized participants, settlement agents, the whole life cycle more efficient. But that's one of the biggest questions that we need to answer in the next months, years, is how far are we stretched into the tokenization concept?
No, I love that. Just because you can doesn't necessarily mean you should or people want you to. I think crypto has definitely seen that in tokenization specifically. Like you said, some of these products just don't have demand. You also mentioned zero-knowledge proofs, though, and I want to go back to that. In terms of privacy solutions, digital IDs, et cetera, I know that privacy and security is obviously a top concern for institutions. I think it is for the retail and investor side as well. How can those kind of solutions be scaled? How are you thinking about them? What can you share?
So, yes, within the city, we have a global center of excellence, which is with specific mission of understanding and creating and working with the industry of solidifying the best practices around token standards, but also data privacy, and what the specific levels and shades of data privacy we need to have in place. So for us, as you rightfully said, privacy is paramount, and we need to feel comfortable with the degrees of privacy that we have. So we've been exploring and we've been thinking about different privacy solutions, FHA, zero-knowledge proofs. So, and I'm very excited for the next topics. I know it's around zero-knowledge as well, so I definitely would listen to it. But it's for us, it's something that we want to definitely experiment. We want to try, test. It will be the same crawl, walk, run approach of like testing, but the important piece is how much privacy you need without breaking composability, without breaking interoperability. And just because you can, let's say, quote unquote, encrypt paywalls, encrypt assets and everything, will smart contracts still operate? So I know there's a lot of innovation with ZK VMs, with frameworks around zero-knowledge proof from partners that we already have now, and we are very excited to be working with them. So it's this type of momentum where there is external innovation happening, and we as a bank, we are understanding what is the right degree and how to properly use it.
Yeah, I was gonna say, our team gets very excited about the sort of like promise of digital identity and on-chain privacy, so much so that like last November we released a project called Project Epic, which was enterprise privacy identity without forsaking composability. And I think there's like, you know, to the point that Beezer's making, a couple of reasons as to why. For most of our clients and for most individuals in the banking system, like privacy is a non-negotiable, or at least it has been for all these years. And so when we think about scale, right, and when we think about sort of like the efficiencies that we want to introduce through tokenization, not just for the sort of like subset of the world that is comfortable interacting on like existing networks without sort of forms of on-chain privacy, but also those that we want to like bring into those ecosystems to also partake in the benefits. We need to think about like meeting those clients and meeting those people like where they're at when it comes to their expectations for privacy. So a lot of the advancements that have taken place in the zero knowledge space have definitely, you know, given us a lot of excitement and confidence that the sort of like innovation that we continue to push and drive and create businesses around are ones that can head into a direction where, you know, for certain use cases, maybe you're totally comfortable and fine operating in a public state. But for those where you're not, you have the optionality and the flexibility to like tap into those privacy sources. And same thing for digital identity, right? Like I think even more so than with sort of like the privacy conditions or parameters for assets. I think identity is one of those things where we're like, from day one, we want to make sure that you know, if we're to issue out attestations to our clients' identities, or if we're to issue out tokens that represent identities, those clients, those investors, those entities that we interact with aren't forsaking sort of the privacy around their being just to interact with an asset in a more efficient and effective manner. So definitely excited about, you know, even just this week, like some of the things that have been announced in the space around sort of the constructs of like verification and bringing that into DeFi. It's like one of those things that we've been thinking about since like 2022, I want to say. And sort of our efforts to continue coupling, you know, the research and not just research at this point, actually, like tangible progress that's being made. Not that research isn't tangible progress, but the work that's happening in the privacy ecosystem with the work that we've done previously in digital identity and in privacy preserving assets, we think will open us up to a lot more from a scale perspective.
Just want to add something. It's very important that we, as a financial institutions, test and dip our toes with the technology and trial and test. But more importantly, I think the whole ecosystem needs to lift, as we say, the tide lifts all the boats, because it's not just few institutions making an effort. The whole enablement needs to happen end to end. So it's asset managers, banks, intermediaries, custodians. These type of solutions involve a plethora of ecosystem players that we all need to get on, and that's the difficulty of it, because there should be sufficient standards in place, sufficient certainty of risk reduction and operability and resiliency, and everybody as counterparts on a transaction needs to be comfortable with this. And that's I've seen in the past few years that folks were testing as we are testing, and but it needs to be a common consensus, no pun intended, to agree on a standard how to do privacy, on how to implement decentralized IDs. Yeah. So it would take, I would say, months, maybe years of getting everybody up to the same level of understanding and agreement how to best use it.
Yeah, definitely. Like, you only get so far down the path if you can issue just your direct client a credential, but then they're not able to use that anywhere else, right? Like, the whole point of the game is like efficiency through reusability for identity credentials, and so Beezer and I have to work together.
Well, I mean, going off of that, something that we talked about on the prep call for this was, are public networks mature enough for institutions? And that might be fighting words for some people in this room, but I'm curious how you're thinking about public networks and the maturity level. Do you want to start?
I can start, yeah. So we've seen the evolution of public networks for the last 15 years, starting from 2009 with Bitcoin. But it's interesting, in order for them to be fully enterprise ready, they need to meet specific criteria. And also they need to be into a state of assurance that there's some certain predictability. And the way I think about it is, in the last few years, some networks had that predictability and usually stayed stable, and you would know that if you issue an asset that it won't hard fork and you have two assets on two different networks. But also with the expansion of roll-ups, layer 2s, app chains, and everything else, I'm not sure if it serves the purpose of solidifying the right platform, the right protocol for issuing assets. Because I know it improves scalability, but on the flip side, it's create more fragmented markets, more fragmented order books and liquidity. So I'm not sure if it makes it easier from an institution to have a predictability and assurance that this will be the target state of networks. And we've seen that from the public roadmaps or the lack of public roadmaps that some public networks have. I think there is a gap that needs to be filled of obviously expectations from institutions on one side, and getting semi-comfortable with some risks, or driving the technology and driving the operations and the risk, and on the public side to give these assurances that yes, the networks are here to stay, they will continue to operate. These are the SLAs, quote unquote. I'm not sure if that's applicable even in the public world, but the SLAs that you can maintain.
Yeah, I know we're at time, so I'll keep it short. I feel like it's a trick question because institutions are already there. So I think really what it comes down to is like the use case and the scale at which an institution wants to be operating on a public chain. I think for us in particular, we've seen really amazing advancements in the space. Beezer mentioned a few of them. I think account abstraction, sort of like the flexibility that people have when setting up our wallets and being able to maintain and preserve strong user experiences with strong levels of like flexibility and security is one thing that has given us a lot of excitement around the space. The advancements in ZK, the advancements in digital identity, I think mentioned the verified pools. All of these are different things that are making us really excited about what the prospects are in the public space. So I think it's just a question of time.
Definitely. Well, thank you so much. I really appreciate your time. And thank you for joining us at the Digital Asset Summit.
Thanks for having us.
Thanks for having us.
Let's welcome Diana Biggs, Alex Cordovo, and Gobi Nadesh.
Good morning. Well, I think we had the perfect segue from that panel for us to dive in deeper into the topic of ZK for institutional finance. I'm Diana Biggs, partner at 1KX, and joining me on stage is Alex Cordovo, CEO of Tradable Financial, and Gobi Nadesh, who is Senior Product Manager at WonderFi Labs. So blockchain adoption has happened in certain pockets, but we're yet to see really substantial adoption from the institutional front. You both are coming from very different businesses. I'd love to hear from each of you about why you've chosen to move forward with this technology.
Sure. I think there's a lot of excitement, especially from the institutional financial sector, about blockchain technology. I think, though, that a lot of institutional financial folks don't even know how to get started in the space right now. We've seen a lot of adoption over the last couple of months in particular, but I think the promise of, blockchain technology, the crypto ecosystem in general, is that kind of next generation of stability, security, interoperability, and scalability for financial institutions. I mean, most of the folks in the world, especially on the institutional side, they're operating on really old technology, or they're very, very delayed in adopting technology. And so they see this as kind of a reset of sorts, of being able to adopt that next generation and kind of work with the rest of the world, come to the future, essentially.
And Tradable had its origins spinning out of a global asset manager.
Correct. So Tradable spun out of Victory Park Capital. It was a joint venture between Victory Park Capital and Spring Labs. Victory Park is a large asset manager, large global asset manager based in Chicago. And the essential thesis was that all transactions, or some major part of them, is going to go on-chain in the future. And as an asset manager, Victory Park wanted to help shepherd and lead, as opposed to follow with what could end up being subpar technology, if not for the institutional expertise that it had.
Fantastic. And WonderFi.
Yeah, thanks for having me. So history of WonderFi actually started in 2017 as a DeFi business out of Vancouver. But as some of you may know, in 2017, when market conditions changed, the co-founders at WonderFi decided to kind of switch gears and realize that retail wasn't really ready for DeFi at that point, and switched into actually making it easier for users to on-ramp into this kind of world. So this is when WonderFi became more of a centralized exchange business, and they acquired both BitBuy and CoinSquare, which was two regulated exchanges in Canada. And so now WonderFi is the largest regulated exchange for retail users in Canada. So now, 2024, 2025, we've decided to kind of go back into the DeFi space. And so we've spun up WonderFi Labs inside of WonderFi. It's a very small team of 8 people right now. And so our focus is actually building on now bridging those users who are using the centralized exchange and actually allowing them to bridge into the DeFi space and Web3 space. And so we've launched our own chain built on ZK Stack, Wonder Chain, which is on testnet right now. And the goal really there is to address some of the core problems we've seen for users who want to adopt into DeFi and get into the Web3 space, and trying to solve some of those problems with our unique implementation of ZK Stack and our chain.
And Alex, you alluded to this, and obviously for us, we're big believers that all financial transactions will go on-chain. Why was that apparent to you? Why do we believe that this is the way forward?
Yeah, so I've been around Bitcoin, crypto for about 15 years now. I was on some of the original, Bitcoin forums. I made 2 great investments in my life. One was buying a bunch of Bitcoin for $1 and then selling them all for $40 each, which, considering now, maybe not such a great investment. But then the other one was tracking the crypto, ecosystem, or the blockchain ecosystem, all the way up to where it is now. And I think we've continued to see not just problems come up, but solutions come up. There's been a lot of solutionism, and I think we've seen that this is a serious ecosystem that can grow, that can address problems that it has, and ultimately, every time that we run into a problem, there's a new solution that comes up. I think, the existence of things like ZK Sync, zero knowledge proofs, we can obviously get into some of the promises of those, but we've continued to see this growing adoption over the last 15 years, and in a technology that promises essentially to be that next layer, that next generation of financial transactions. I think that as we see more and more adoption and more lean-in from traditional financial institutions, that promise is only going to continue to grow. We can say a lot about the specific underlying technology, the reasons why I think, the promise of interoperability or the promise of like standards-based technology as opposed to kind of the mishmash of Web 2 tech is better. But I think it's just fairly apparent that's where the world is going.
Let's dive into that because I think these early decisions around which technology to build on, and today we have a lot of different options regarding which stacks could be used. What were the unique challenges or requirements of your businesses, and sort of walk us through the evaluation of what led you to go with ZK chains?
Yeah, for sure. I can start there. So when we were launching Wonder Chain, there was quite a bit of discussion that we had in terms of what tech stack that we were going to be using. And the way we approached our L2 was looking at core user problems for people who want to onboard into the DeFi Web3 space. What are the kind of biggest challenges that they face? Wallet infrastructure is one part of it. The other part of it is kind of this gas token paradox. So people who want to go on a specific chain and interact with a protocol, they might move USDC from a centralized exchange account to a wallet and try to interact with that application, and the first thing they're hit with is like this need for this other token to pay for gas, which sometimes seems very arbitrary or irrelevant. Like, why do I need this specific thing to do this one thing that I want to do? And so gas token paradox, I think for people who are in the space, they're very knowledgeable about that and they're very used to that. But for new people coming in, that's a huge hurdle. And so the reason why we kind of went with ZK is their paymaster implementation that we can implement at the chain level to be able to subsidize transactions. So if a user is just simply trying to onboard onto a platform, which is a non-time sensitive transaction, we can actually subsidize those transactions to make that process smoother and easier. And I think we chatted about some challenges that people have even in onboarding to certain platforms. Sometimes takes days, back and forth. These are not time sensitive transactions, and they really could be subsidized without having to force a user to go and get another token to pay for gas. And so that's one of the big reasons we kind of settled on ZK.
Evaluating spinning up Tradable, spinning out Tradable 2 or 3 years ago, we knew kind of from the get-go that we needed some semblance of zero knowledge proof, right? The previous panel alluded to this, but the promise of kind of privacy, security, and then interoperability is what we were indexed on. For alternative asset managers in particular, they're very, very privacy sensitive. They're very, very sensitive to, potentially side channel attacks for information, or just quite frankly, competitors being able to over-index on what any particular firm is doing. So we knew we needed to have privacy, but we also knew that we wanted to build Tradable on a public chain, right? There's still an enormous opportunity for on-chain distribution. I think that world will come, but all the capital formation to date has been on public chains. It doesn't do anybody any good if everything is done on a private chain and then you can't, play in the sandbox with anybody else. You've got to be able to work with the rest of the world at the end of the day. And so when we try and balance privacy and security with the goal of interoperability, I think ZK chains were, quite frankly, the only true path forward. When we were evaluating building up Tradable, this is back 2 or 3 years ago, ZK Sync was clearly head and shoulders further along than anybody else, quite frankly, and they've been exceptional partners to date. They've continued to be very responsive, building new technology. I think it's excellent technology, and it is essentially table stakes for getting a traditional financial institution to adopt the technology, to have that promise of security, that promise of privacy, but also that promise of interoperability with the rest of the world.
From the retail perspective as well, are you seeing the demand there, or is this sort of the beginning of the journey?
I think it is the beginning of the journey for retail users, at least in Canada. We've seen implementations of this, like larger centralized exchanges that launch their own layer 2. And so, especially for the Canadian regulated space, there isn't really much of an avenue for those users to seamlessly bridge into DeFi and Web3. And so, yeah, we're kind of hoping to be the trailblazers there with our ZK chain. And I think interoperability is kind of, as Alex alluded to, the biggest kind of benefit of having like ZK infrastructure with their elastic chain infrastructure. You basically have an ecosystem of ZK chains that has underlying interoperability kind of built in. So yeah, I think so.
So talk us through the use cases. You have met the requirements in terms of the privacy needs, and you've sold them on this. Where are you seeing the demand?
Yeah, so Tradable, for those who don't know, Tradable is a private credit marketplace. It is by institutional finance for institutional finance. And I think, adoption to date has been, especially considering the kinds of assets that Tradable has, these private credit deals primarily, adoption has been from traditional financial institutions. Most of what gets sold or transacted on through Tradable is a private institution or a private manager originating a deal, and then some portion of that potentially being purchased by a traditional financial institution. We actually haven't seen a ton of lean in on the on-chain native distro side of the house. We can theorize why that is. I think there are maybe some investor mismatches or expectation mismatches about liquidity, but Tradable is very much in the business of meeting people where they are today, because we do know that transactions are going on-chain. We do know that in 2, 3, 5, 10 years, whatever it is, that all these transactions are going on-chain. We want the traditional financial institutions to trust us, to trust that we've done all the hard work of tokenizing these things correctly, building the smart contracts for interest and principal repayments correctly, whatever it is, so that in that new world, they trust us to be, essentially be their shepherds into the space.
And are you seeing that early adoption?
We are. I don't want to share too many metrics right now, but we've seen a lot of lean in from traditional financial institutions from all over the spectrum, from family offices all the way up to obviously we've got a bunch of global banks here represented.
Fantastic.
Yeah, I think on the retail side, right now, as a retail user, your assets are kind of divided into these 3 different classes. So you'd have fiat with traditional banks, then you have your equities, bonds, probably with a brokerage, and then you have retail users who are adopting crypto as well with centralized exchanges. There's definitely a huge appetite that we've seen from retail crypto users who move their funds off our exchange into private wallets to interact with DeFi. But I think there's a huge appetite for institutions to also tokenize those equities and bonds to be able to give users who are already trading crypto a really easy way to transition and purchase those assets as well that are much more liquid and can be used, for example, as collateral in other places. Right now, you're kind of locked in. If you're with a brokerage account as an end user like myself, you can buy and sell equities there, but that's really all you can do. So the ability to kind of have interoperability where you can take those, let's say if they were tokenized on chain, and even trade them or use them as collateral, there is an appetite for end users on the retail side to get into some of those investment opportunities.
So what would be the next step for the unlock for adoption? Where are you seeing maybe there's still some barriers to entry when you're having these conversations? What are people looking for next?
To pick up kind of where Gobi left off, he used the example of getting a loan or something or participating in DeFi more broadly. I think right now that is the most difficult thing for traditional financial institutions to stomach is the permission versus permissionless barrier, and then being able to fully dig into the true promise of DeFi interop, right? That is much more of an underwrite or much more of a difficult, thing for a traditional institution who's, to be clear, their remit, their mandate is not to adopt new technology. Their remit or mandate is to, do right by their investors. And so until they see a clear value proposition to adopting DeFi and all the promises that it brings, which to be clear, there are, secondary market transaction, things like Uniswap, Aave, whatever, there are plenty of reasons that you would want to get into DeFi, but until there is that killer use case, or until there is that, alignment of interest between the, call it the alternative investment, or the alternative asset investor, and, DeFi more broadly, I think we're going to see a little bit more trouble trying to coax the institutions into adopting, full in on DeFi. I think we're going to see people build towards that. I know there are now, verified pools or whatnot, things like that people are starting to build towards. Quite frankly, I think those things are table stakes for institutional adoption. And so over the next 12 to 18 months, it'll be very exciting to see who leans in, who's willing to kind of lead from that perspective. But until we get there, I think there's still a little bit of, a mismatch.
Yeah, I mean, adding to what Alex said, I think there's definitely a few hurdles on the institutional side. I think in the previous talk they were talking about decentralized identity being a huge factor right now in terms of onboarding users, doing that KYC, ML, and from a compliance and regulatory perspective, having a set standard that institutions would use. And I think right now the early exploratory phase that institutions are taking is still kind of closed ecosystem. So it'll still be kind of siloed kind of chains, privacy-focused chains for their specific use case and for their specific clients. But I think the beauty of interoperability on ZK's Elastic Network is you can actually have a purpose-built chain that deals with decentralized identity that institutions can agree on being the standard. And then, with zero-knowledge proofs, you can have the ability to show, like as a verifier, I can show to a person, hey, I have these credentials without actually exposing the underlying data. And if there is agreement on that type of standard and there's regulatory clarity there, I think that opens up a lot more use cases, especially on the Elastic Chain Network. Yeah.
And now that we're getting that increasing regulatory clarity and we have the underlying tech stack, what opportunities are you most excited about when we look at the next 1-2 years of where you're both headed?
Yeah. Well, not to be too kitschy, but it's in the name, right? We want to make the world tradable. We're going to start with alternative assets, and then we're going to expand from there. There's so much out there in the space. If I want to be able to, swap some of my commercial real estate exposure for some of your, consumer lending exposure, I should be able to do that on a decentralized exchange and not, have to hire an investment banker who's going to tell me I have to take 80 cents on the dollar after 6 months, and then, he'll stack on his 5% fee after that too, right? Disintermediation is the big thing, transparency, and essentially once everybody is on the, call it same standards, or everybody's in the same sandbox, I think you get to a much more interesting, much more interesting world. We saw this with Web 2 financial transactions and how it kind of opened up the globe to substantially more in the way of essentially people working together and people being in the same ecosystem. I think we're going to see that for TradFi.
Yeah, on the retail side, I'm just very excited for retail users to have access to more complex financial investment products. Like right now, DeFi exists. There's other opportunities like Aave where you can do collateralized, over-collateralized type loans. But I think there's a lot of opportunity for established players in the TradFi space to bridge some of their existing investments that they have into the DeFi Web3 space and give retail users access to some of those more trusted names and trusted products to invest in, giving them like a real alternative to doing things on chain as opposed to just buying and holding crypto assets.
Fantastic. Well, a lot to look forward to. Thank you both, and thank you, everyone.
Join me in welcoming Vivek Raman, Joseph Lubin, and Robbie Mitchnick.
Good seeing everyone. Hope you're all excited for the president. Before that, we're going to have a panel on institutional adoption and Ethereum for institutional builders. We have here Joe Lubin and Robbie Mitchnick. If you just want to quickly introduce yourself, and then let's get into some
Hi, I'm Joe Lubin. I work at Consensus. We are an Ethereum first pan ecosystem company. We publish MetaMask, which is an interface to as much of Web3 as we can cover, and we build developer tools that also are applicable to different blockchains.
Awesome. Robbie?
And I'm Robbie Mitchnick. I'm the head of digital assets at BlackRock.
Cool. Well, Ethereum from an institutional standpoint is at an inflection point. We want to start with one of the biggest product market fits for Ethereum, which is tokenization. BlackRock, Robbie pioneered BIDL, just recently crossed $1 billion in AUM, which is congratulations on that. And BlackRock, as culturally, has been saying that all assets should ultimately be tokenized, and you're leading the charge there. Can you talk about the journey for BIDL and specifically why you started on Ethereum and what your plans are for the future?
Sure. Well, that journey started really back in 2020 when we first started doing work around tokenization, and that, I think, somewhat naturally began in a private blockchain context. I think that was true of just about every TradFi firm as a starting point. We did some interesting work there that I think was very valuable from a learning and capabilities development perspective. But one of the, I think, very clear takeaways from that work was that public blockchains were actually where the future would be in this space. And so we made a pretty decisive pivot at that point to focus our efforts in tokenization around public blockchains. I think that was a fair bit earlier than many of our bank partners, for example, were comfortable doing that. But I think that decision appears to have been the right one because more and more activity is absolutely congregating, even for traditional finance institutions in the public blockchain space, and not a lot is really happening at scale in a private blockchain context. And so when we developed BIDL, it was in response to what we felt was a clear need in the market for access to US dollars and US dollar yields in an on-chain format, right? And to have that be interoperable with stablecoins in particular, that's a really compelling value proposition that gets at the heart of what the savings and payments paradigm that exists today in our banking system is, in a potentially very transformative new construct. So BIDL's been very successful so far. It's been hard work, building this up to the size it is today. $1 billion, as you note, is a great milestone, but it's still very small in the context of our global cash management business, which is around $800 billion. Yeah. So we have a long way to go, but we're excited by the progress that we've found.
It's awesome. Joe, you've been in Ethereum since the beginning and co-founded it. Why do you think right now is the moment for institutional adoption for public blockchains versus other times where we had more private blockchain consortia?
Cool. So let me jump into that in one sec. I just wanted to, I think it's valuable to talk about tokenization a bit more. So the value proposition of tokenization is that like standardization, like digitization, it reduces frictions, it increases productivity and velocity in the economy. And Larry Fink has sounded recently like like a crypto degen from 10 years ago, where he says tokenize all the things. That used to be a rallying cry for us, and we have this with universal markets, with this universal format of tokens, fungible, non-fungible, different tokens. They can all trade against one another, and so we're going to have liquidity for so many more assets and so much more velocity. Why is this Ethereum's moment? We have been building layer after layer of enabling infrastructure, either at the protocol layer, scalability layers, DeFi layers, identity layers, and we're just about at our broadband moment where Ethereum, and I think of Ethereum now as metropolitan Ethereum, so there's layer 1 and then there's lots of layer 2 and some layer 3 networks that are all connected to one another. We are now scalable enough in terms of our ability to add horizontal scalability and vertical scalability. We're now affordable enough, so block space is cheap, blob space is cheap. Ideally, it will stay cheap for a long time. That won't happen soonish when things get really busy at Ethereum layer 2s, and they're all settling to Ethereum layer 1. Ether will get expensive at that point. Usability is quite good and is going to get amazing over the next 12, 18, 24 months as we add AI to user interfaces and be able to just express our intents and have solver networks take care of what we want done and probably take 2 seconds to get things done. And in the United States of America, it is now safe and explicitly legal to be a blockchain company. So that's great for us because it's been hard for a few years under the previous regime. But it's also really interesting for organizations like BlackRock, for software developers in TradFi or in Web2, because now they can feel comfortable holding tokens, participating in DeFi, or building applications for consumers. We've been building a lot of infrastructure, some great applications for crypto nerds or art nerds, but we really need the big unlocks that will come when Web2 entrepreneurs and developers come and make use of Web3 primitives so that they can build applications that are essentially of, by, and for the community rather than building in a more adversarial mode as the legacy economy prefers.
So Ethereum's moment really is now where the Web2 and TradFi players all converge with the existing infrastructure, and it's incredibly exciting. One other massive milestone for adoption has been the ETH ETFs. Everyone's seen how spectacular the Bitcoin ETFs have been. Robbie, you have the largest Bitcoin ETF and also the largest ETH ETF. Could you give some context as to, on a relative basis and absolute basis, how the ETH ETFs have done and what you expect for the future, including potential for staking?
Yeah, well, I think there's a little bit of a misconception out there that the ETH ETFs have been meh. Yeah. And the truth is that, take ETHA, for example, iShares Ethereum Trust, had $4 billion in inflows in its first 6 months. The number of ETFs historically who have had more than that is a very short list. But when you compare it to IBIT and the Bitcoin ETF complex generally, it doesn't look that amazing. When you compare it to the actual ETF universe, it's actually been incredibly successful. So I know some people have that perception out there, but I can say that from a BlackRock perspective, we think it's been tremendously successful, both commercially and the way that these products have functioned, the market quality, liquidity, et cetera. There's obviously a next phase in the potential evolution of this because a ETF, it's turned out, has been a really, really compelling vehicle through which to hold Bitcoin for lots of different investor types. There's no question it's less perfect for ETH today without staking, right? That staking yield is a meaningful part of how you can generate investment return in this space. And all the ETFs, of course, at launch did not have staking. So if that is able to get resolved, it's not a particularly easy problem. It's not as simple as, you know, a new administration just green lighting something and then boom, we're all good, off to the races. There's a lot of fairly complex challenges that have to be figured out. But if that can get figured out, then I think it's going to be sort of a step change upward in terms of what we see the activity around those products is.
So zooming out then, one of Ethereum's greatest strengths is also potentially one of its weaknesses, which it can do a lot of things. It has been a world computer. It's a substrate for the financial system. It's going to integrate with Web 2. How do we simplify this narrative? So a question for both of you is, how would you today describe ETH to your clientele when you're talking about the ETFs or talking about Ethereum's potential? Let's start with Joe.
So it is too big. It's too big to describe. It's like trying to describe the internet protocols and the web protocols. It can do everything just the way you can do pretty much anything on the web. And so there are people who can grok all of that, who can hold a lot of the complexity and the potentiality in mind, but most people are not going to be able to do that. And so we have to focus on applications that a user or a company cares about. And so we are at our broadband moment, and we will see applications like social graphs, decentralized ID, attestations, reputation, things that you can use inside of different applications. We simply have to focus on a little more narrowly and trying to describe the potentiality of Ethereum just leads people to being a little bit overwhelmed.
So if we narrow that scope, then Robbie, how do you describe ETH to the institutional crowd and to the TradFi crowd in terms of use cases or the asset?
Well, it's interesting because I think there's no question today that the investor narrative clarity, particularly for kind of marginal adopting institutions or financial advisors, is a lot clearer for Bitcoin as this digital gold story. But actually, ETH in some ways at the second grade level is easier to define than Bitcoin, but you know, at the 10th grade level is a lot harder, right? Second grade level, it's a technology innovation story. Great. Once you start to get beyond that, it does get a little more vast, a little more complicated. It's about being a bet on blockchain adoption and innovation. That's part of the thesis as we communicate it to clients. And then when they want to get down to a little more tangible level, we could talk about some of the more specific use cases that it unlocks. And obviously there's a lot, but you know, three that we focus on that have a lot of resonance with our client base is it's a bet to some extent on tokenization, on stablecoin adoption, and on decentralized finance. And so that, I think, resonates, but it does take a fair bit of education, and so we've been on that journey, and it's going to take, I think, more time.
Yeah, so one way that might resonate with people who spend a lot of time on the web is to look historically at where the web came from. The internet protocols were essentially open specifications, open protocols, open source. Web 1 comes along, same thing, open source, open protocols, open specs. And the web was a revelation to people. It felt safe and healthy. The communities were not at each other's throats on the early web. Web 2 comes along, so late 90s essentially, and suddenly there are great financial prizes to be won by companies that are building these social networks. And and then they start adding AI to these social networks, and they start to know us better than we know ourselves, and they figure out ways to run psychological experiments on the population or addict the population to doom scrolling, and adding mobile to the Web 2 protocols and e-commerce, et cetera, turned it all into still an amazing global resource, but something that has increasingly grown toxic and has been destructive of the fabric of society. And so you can think of Ethereum as a major foundational component of Web 3, and Web 3 is the re-decentralized web. So Web 3 is open source, open protocols, open specifications, lots of people, lots of projects collaborating with one another, building things of buy-in for the community rather than in an adversarial perspective.
So one of the best parts about Ethereum is it is a technology platform that will continually evolve to onboard the whole world, from institutions to Web 2 players to all consumers. For both of you, what is on your wish list for what Ethereum needs to accomplish to really cross the chasm for full institutional adoption? What are the one or two major things that we need to see to actually unlock full adoption, starting with Joe?
Ethereum version 1 was never meant to be scalable. We understood that we wanted to build this programmable blockchain, smart contracts that anyone could permissionlessly build on and permissionlessly access. Essentially the idea was to re-architect all the systems of the world on sounder foundations, and those sounder foundations were essentially invented by Satoshi in the form of decentralized trust. We built Ethereum version 1, and it kicked off a remarkable amount of activity and innovation, quite a sophisticated proof of concept, essentially. And it has evolved to the point where we needed to add scalability. We needed to try to figure out how to turn this thing into many things, essentially, that all communicate well with one another. So in adding scalability, we had to do a divergent exploration where we tried to build lots of this idea of execution sharding inside the protocol. That was too complicated at the time for the technology to address, and so we threw it out to entrepreneurs and researchers in this divergent phase, and we have achieved horizontal and vertical scalability. And so any new innovation tends to uncover, either create or uncover other weaknesses. And so the weaknesses that we introduced, and we knew we were going to introduce them, was essentially fragmentation of the ecosystem and loss of synchronous composability. And so there are many efforts right now to do two major things. One is reduce fragmentation in the ecosystem, get back to synchronous composability or near synchronous composability. Intent-based architectures and solver networks are helping with that. And this idea of taking this zero-knowledge proof technology that we developed and bringing that down into the Ethereum protocol and enabling lots of different Ethereum machines to stay in sync and be essentially native rollups. That's one major set of research initiatives, and the other piece is just related to that, basically to beef up layer 1 because it needs to handle the world's transactions.
A lot of users. Robbie, what's on your wish list for?
Well, I feel like you just asked for insights on the game of football, and he's Tom Brady, and I'm the ball boy. So I won't try to compete with that answer, but I'll just say maybe very practically from an asset management perspective, one of the things in the roadmap that will help, particularly as we were talking about staking and how you make those work in ETFs, having XQs ultimately come down and be more predictable will really help in that way.
Yeah, so in having institutions like BlackRock serve as a forcing function for our ecosystem, for our technology, for our different research teams is wonderful. So we do a lot of thinking about things that they care about. Execute is one of them. Balances, max effective balances, reducing the number of validators, reducing the number of the amount of bandwidth necessary in these peer-to-peer systems. If we're looking at the ETFs and wanting to add yield, one of the major dangers of staking is that you could be slashed, and that's the way it's supposed to work. But if we can do things to evolve the protocol or just evolve how the ecosystem works, for instance, we have 5 execution clients that all sync to one another according to a specification. If we can make sure that all the activity is very evenly distributed across those 5 clients, then any sort of staking penalty will be much smaller than if there's too much concentration in one of those clients. So.
But Ethereum is responding to demand and institutional adoption, so we appreciate everything from like BlackRock leading the charge on that. Last question, and zooming out, we are in a new paradigm of blockchain adoption. There's a lot of different players out there. There's a lot of competition out there. Ethereum was founded on the basis of decentralization and being a resilient network. I'll zoom out and ask as the final question, does decentralization matter anymore from an institutional standpoint, and what value do they put on a decentralized network? I'll start with Robbie.
Well, I think it does matter. I think some of the negativity around Ethereum in the narrative lately is very overdone. There's a lot to be optimistic about. Joe's obviously characterized that very eloquently. When you look at our experience, take BitL as an example, there was no question that the blockchain that we would start with our tokenization on would be Ethereum, right? And that's not just a BlackRock thing. That's really anybody who would enter this space. That's the natural default answer, right? That's really important. And you see even today, we're excited about having this be a multi-chain product now. We're seeing assets across all of them, but Ethereum has, a significant majority of the assets still. And so clients clearly are making a choice that they do value the decentralization, they do value the credibility and the security. And that's a great advantage that Ethereum continues to have.
Yeah, so decentralization is the whole point. It's why our industry exists. There will always be well-resourced, patient actors that will corrupt, co-opt, censor systems if they're able to. There are famous incidences where the NSA in this country has been part of the cryptography ecosystem and adjust parameters to make it more easy to infiltrate or manipulate systems. The idea of sufficient decentralization is reasonable. So not every network has to be perfectly rigorously decentralized across all relevant dimensions, but some of them do. Bitcoin does, Ethereum does, and we will continuously progress decentralization and guard it.
So I think we're at time, but this is a new era for Ethereum. Very, very thrilled to have Robbie and Joe up here, and we're excited to see all the institutional adoption that's about to happen.
Please welcome Jack O'Halloran.
Hey everybody, how's it going? Pretty exciting day, huh? All right, that was an awesome panel. a lot of talk about adoption. That's what I'm talking about. So quick show of hands, who took an Uber or Lyft here today? Okay, which data center did you use? And how much did it cost you to process that data center transaction? Was it Google Cloud, AWS? No? You know what? That's an invisible experience, an infrastructure experience that you didn't need to know what you're using on the back end. And that's one of the things we've learned in Web 2 is that having invisible, frictionless experiences is how we grow and how we get mass adoption. Okay, so that's what I'm talking about today. I'm talking about invisible blockchains. All right, here we go. So quick question to ourselves. Are we ahead or behind where we should be as an industry right now? And it's a tough question to ask yourselves, but I think it's healthy to do it. Now, every time the market drops, our kind of normie hater friends, or even people in our different chat groups who get a little pessimistic will say, there's no real use cases for blockchain other than store of value. Speculation's the only use case. No one uses blockchain. It's just 500,000 people trading with each other. I personally think that's garbage, okay? I don't believe it, but my goal, and I think our goal should be to make that not even a topic of conversation, okay? By the way, I'm not talking about how many people have a Coinbase or a Binance account and own crypto assets. I'm talking about what Joe was talking about earlier, real use cases that drive the needle, real use cases of blockchain, global use cases of this technology. And hey, if you took an Uber or Lyft here today, that was a phenomenal use case to leverage cloud computing on the back end, okay? And it was a seamless experience. We need these experiences in Web3 so we can get across the chasm, okay? So this is, a very old chart here. Jeffrey Moore wrote this a long time ago. It's still true, okay? So who's familiar with this, crossing the chasm? Okay, we have some hands. So you have your early adopters are frankly your tech enthusiasts, okay? This is the early market. You then eventually hit this chasm and you have to get through it or you'll fail. But if you get through it, there's a tremendous trajectory because the pragmatists and the conservatives come soon after, the early and the late majority. Now, in order to get there, you also have to have great UX. I worked in mobile back in 2005. We had, it was a good technology. We had 92 of the Fortune 100 using this product. The only highly used product was email because nothing else worked well on mobile. We had all these other business applications. No one used them. Fast forward 3 years later, we have the iPhone. We have high-speed data networks. We've got much more powerful processors in our phones, and mobile takes off massively. It hit that curve for application usage, not just text, email, phone calls, all right? We're at that chasm now, but 16% is the number, all right? This is where real adoption begins. And again, we have surpassed this in a lot of categories. I think, you think about how many people have an account, how many people own Ethereum, how many people own Bitcoin, how many people own these different crypto assets. I think we're safely there. Let's look at gaming. Scale is one of the largest gaming blockchains in the world. We are a mass adoption blockchain. We're built for user experience, okay? Gaming now has over 30 million people a day hitting the blockchain. I think we need to applaud ourselves for this. It used to be thousands a couple years ago. We've been on an exponential curve, but there are 3 billion people that play video games every day. So we're only 1% adoption, not 16%, but the good news is once you're at 1, it's much easier to get to 16. It's much harder to get from 0 to 1 in these spaces. So we need mass adoption. Another positive note, we're getting there on the financial side, really getting there. These are areas that require less clean, simple, easy user experience. Look at stablecoins. There were over $850 billion in stablecoin transfers volume in February. That is massive. And you know what? That is money and value moving almost at the speed of light, not taking a day to process, not taking this kind of archaic banking system. This is the new future of money rails working. Bitcoin market cap's over 1.65 trillion. This was, when I sent them the slides, so it's probably higher right now. But that's a win for store of value. That is a phenomenal store of value, okay? The reality, though, is we need more daily users for these use cases that really, really matter, all right? So then it's all about user experience. So I talked earlier about, and I saw, by the way, if you're listening online here or if you're not looking around, when I said, oh, what data center did you use and how much did it cost for that to process it, everyone's like, what are you talking about, right? But in the world of blockchain, that's the reality. So Scale actually has taken a novel approach, and we got rid of gas fees all the way down to the core of the chain. And instead, developers pay chain fees. They rent block space. It just opens up this new user experience. It's still economically viable. People are getting paid to run servers. Entities are getting paid to run servers and infrastructure. But this is an example when you combine phenomenal UX addition with high-speed blockchain execution, zero gas fees for the end user, and integrate that with advanced custodial wallets and semi-custodial wallets, and even non-custodial wallets with some very interesting new UX features that are coming. We can let normal people who aren't engineers, who don't have a ledger device, don't really know how to use sophisticated products, interact with blockchain, okay? Another really critical topic, maximal extractable value, MEV, okay? This is where blockchains don't finalize their transactions, and what happens, well, a blockchain submits a transaction, and guess what? Anybody running a node can see that transaction until the transaction finalizes. And then you have front-running, sandwich attacks. Essentially, money and value is being taken from every user and every transaction through bots. Just last week, somebody did a 220K swap on Uniswap, and they ended up with $5,000 after. They swapped USDC to USDT. No, hey, they didn't use the Uniswap UI. If they had, they would have been protected. They used a different system, but the problem is, this is something that we think needs to be fixed. This is the next frontier for Scale also, is going and trying to fix this problem to make sure these things can't happen. We need to have safe waters if we're gonna really hit these adoption numbers that we are going for. We also need to offer fundamentals. The next growth stage is all going to be about giving tangible value to users, okay? Real value. And there's some phenomenal use cases out there. Really excited about them. So just a little proof this works. And I have to say, this is fun for me now. We started Scale over 7 years ago, all right? And the first couple years the network was live, we would count our users, our unique active wallets, users, and transactions in the thousands. We now have over 1 billion transactions. We have over 3.3 million wallets in the last 30 days, over 91 million transactions. So the model's working, and I'm not saying this to, talk just about Scale, but to say, when you really lean into building a positive user experience for consumer-facing applications, you can get dramatic results. But these numbers, frankly, are just a start. We're now in the top 10 of all blockchains and layer 2s in terms of transaction volume, and in terms of unique active wallets. And, but I think I look at this and our, set of competitors and collaborators, and as an industry, we're just getting started. There's a lot coming. Quick shout out to all the builders. There's over 300 applications building on Scale. I get the luxury every day of working with some really smart people that understand blockchain, but they also understand how to build applications. And there's some exciting things. There are some exciting things happening. So I just want to say, we are crossing the chasm now, okay? And growth will be led by UX-friendly blockchain adoption. I also want to say, because the President of the United States is speaking here in just a minute, we also have this new government regulation that's it's enabling businesses to come and get in the game. I work with some of the biggest sports leagues in the world, some of the biggest brands in the world, and we got put on pause last year. There wasn't regulatory clarity. This is real. Guess what? They're all back in. 100% of them that stopped because they're like, oh, am I going to be able to do this? So this is going to drive real economic value. And Scale, we are a US project. I'm so happy I can say that now on stage, that we are headquartered in the US. So I think combining all these things together, we're teeing ourselves up as an industry to get to that next level of mass adoption. It's been my pleasure. Thank you so much. Have a great day. Goodbye.
Please welcome to the stage Jason Yanowitz.
How we doing, everyone? Good, good. I'm Jason Yanowitz. I'm one of the co-founders of Blockworks. In about 30 seconds, we have a historic moment. The President of the United States is going to address the Digital Asset Summit. This is the first time in history that a sitting president has addressed a crypto conference. I know everyone has their phones out, but please give a massive round of applause and help me welcome the President of the United States to address Digital Asset Summit.
To everyone at the Blockworks Digital Assets Summit. It's an honor to speak with you about how the United States is going to dominate crypto and the next generation of financial technologies. And it's not going to be easy, but we're way ahead. Just 2 weeks ago, we hosted the first ever White House Digital Asset Summit, bringing together many of the world's top leaders in crypto for a conversation led by our White House AI and crypto czar, David Sachs, who's a fantastic and very brilliant guy. That same week, I signed an order creating the brand new strategic Bitcoin reserve and a U.S. digital asset stockpile, which will allow the federal government to maximize the value of its holdings instead of foolishly selling them for a fraction of their long-term value, which is exactly what Biden did. He got a fraction of their value. We're ending the last administration's regulatory war on crypto and Bitcoin, and that includes stopping the lawless Operation Choke Point 2.0. Operation Choke Point went beyond regulation, and I mean far beyond. It was a form of lawfare through government weaponization. Frankly, it was a disgrace. But as of January 20th, 2025, all of that is over. I've also called on Congress to pass landmark legislation creating simple, common sense rules for stablecoins and market structure. With the right legal framework, institutions large and small will be liberated to invest, innovate, and take part in one of the most exciting technological revolutions in modern history. It's so big, it's, I think, as big as you can get. Pioneers like you will be able to improve our banking and payment system and promote greater privacy, safety, security, and wealth for American consumers and businesses alike. You will unleash an explosion of economic growth, and with the dollar-backed stablecoins, you'll help expand the dominance of the U.S. dollar, and many, many years to come, it'll be at the top, and that's where we want to keep it. We only want to keep it at the top, always. I can already see that the energy and passion of the crypto community is the kind of spirit that built our country, and it is exciting to watch as you invent the future of finance. And right here, it's going to be right here in the USA, the good old USA. Together we will make America the undisputed Bitcoin superpower and the crypto capital of the world. Thank you, good luck, God bless America.
Please welcome to the stage Ben Strack and Stacy Warden.
Yeah, quite a moment. Seeing
President of the United States is unbelievable.
First sitting president to address a crypto conference. So what a moment. It's a privilege for me to share the stage with Algorand Foundation CEO Stacy Warden.
Almost like the President of the United States.
Exactly.
Almost.
This has become quite a coveted time slot here on this Thursday morning. First, if we could just get a brief introduction, if you could briefly introduce yourself and just kind of share, where you were before jumping into leading the Algorand Foundation.
Yeah, I spent a lot of my career in traditional finance. I was at JP Morgan for 8 years. I worked for Mike Milken for 8 years. I worked in the Treasury Department. I ran the microcap markets to the NASDAQ for a number of years. So I have been in and around traditional finance for my entire career. I got interested interested in Bitcoin in 2013. I thought it was really a solution to, I worked a lot in emerging markets in developing countries, so I thought it was a very important solution to some of the issues that they face, and kind of never looked back. And the thing about crypto, it's a one-way street. You get on it, and you keep going further, and you never go back to traditional finance.
Yeah, and we'll get into as many topics as we can in the next 18 minutes or so. But first, we just saw President Trump address this conference. Wanted to get your initial thoughts on, those remarks and how you kind of expect this administration could help spur blockchain adoption.
Yeah, well, the main takeaway for me, and I don't know if you caught it because he did mumble the word just a tiny bit, but the Bitcoin algo strategic reserve was very important, I think, thing that he said. They're going to call it the AB reserve, algo and Bitcoin. No, look, he, make Algorand great again. He wears that hat all the time, so he cares a lot about my blockchain, of course. But he did say, and he always says about making America first, and not just in crypto, but in everything. But it's just after the, as Mark Andreessen said, the foot on your neck, right? Like that we've had for the last 4 years to have, from the very highest levels of government, encouragement and support. And frankly, we don't even need directive support. We just need to, not be hampered, right? Like we have the deepest, most liquid financial markets in the world. If we could just have a level playing field, we can definitely compete globally in the United States. So, of course, I was like the rest of the audience here, very heartened to hear those remarks and how he's prioritizing the sector.
Yeah, and I remember chatting with you 3 years ago when you took over.
That was a long time ago.
Yeah. And now on the inside of this industry, how do you kind of see blockchain tech fitting into TradFi systems, opposing them as we kind of look to build this future-proof financial system?
Yeah, I don't think in a future-proof financial system they're going to be opposed at all. But when you look at the financial markets, they look like crochet. They're beautiful on one side, very seamless. But if you turn it over, there's all kinds of just nonsense going on in the back office. And crypto is, and fintech tries to make that front side even better, but there's still all of this nonsense going on in the back. And crypto is very different than that. It is not a liability-based framework. It is, a bearer-based framework. It is actually digital cash. And a lot falls out of a framework like that can really help traditional financial systems and make them work better. For me, I think there's the big six, which I can just kind of rattle through. First of all, it will help with back office incredibly. If you are just writing to one ledger as opposed to having different kinds of, even internally in one institution, different kinds of balance sheets, talking to each other and constantly reconciling. Just have one ledger. You can get rid of intermediaries. If you look at just the most basic mortgage securitization vehicle, there are so many intermediaries in this. It's basically you set up a vehicle and then you get the mortgage payments, the principal payments, and the interest payments come in, and you have to divvy them out according to your waterfall. But, no offense to the calculation agents in the room, no offense to the paying agents in the room, all of this can be done in code. It's just really can be done with smart contracts. So. And these, just a mortgage securitization vehicle takes, 30 or 40 basis points, right? This is 3 or 4 basis points. This is $30,000 or $40,000 on $1 million loan, right? So just the savings in that can be really profound, I think. And then I think the third thing is composability. Everybody in this audience knows about DeFi composability. We talk about it all the time. But there's other aspects to it which are also quite important, like the ability to just embed finance in anything. A company building on Algorand called Ultrade, you could basically build a DEX. They could white label a DEX for you that you can put in whatever platform you have, right? You can think about identity as a composable framework, Ben. Imagine not having to KYC for every single financial, counterpart that you, imagine being at a bank and not having to do KYC over and over and over. Imagine banks being able to share KYC framework. Stuff like this is, and then of course, I think this is number 4 on my list. You can, tokenization, we've talked a lot about that in this conference. You can create markets that didn't exist before. You can bring liquidity to markets that didn't have liquidity before. We have a number of different examples of that in rental income, for example, where you and I are not going to buy an apartment building to get rental income. but that's a very good diversified source of investment income. And so now, you know, with a company building on Algorand called Lofty AI, you can, and it happens daily because this is Web3. You can buy just for $50 a portion of a rental building or a property of some kind, right? You know, markets that didn't, you know, a company building on Algorand has created a secondary market in airline tickets, for example. Like, you don't have that kind of thing without Web3, right? And then last, Ben, you know, all of this can be yours 24/7, 365 days a year. It doesn't, we think in Web3, we think it's cute that you like wait for the opening bell in TradFi, right? Like all of this, your ability to move money 24/7, it's going to help finance. Like financial traders, they make sure that they're, you know, so electrons are not disadvantaged. They have cables on the New York Stock Exchange to make sure they're not one is like even a tiny little bit further away from the other. But then they take the entire weekend off, you know, and stop at 4 o'clock. It's ridiculous.
Right. And you mentioned tokenization. We've heard a lot of talk at this conference about tokenized real world assets, stablecoins. So we'd just love to hear, you know, blockchain adoption is going to come down to utility, and you know, we've seen some gaining steam, these tokenized money market funds. There's one available on Algorand.
Aberdeen money market fund.
Yes, yeah. BlackRock and Franklin Templeton have their versions of it as well. So just curious of your thoughts on the utility of those, how you expect those to be used going forward, and kind of how they might interact with stablecoins in the future.
Yeah, I will say, and you wrote a very nice article about this just the other day, but I will say that tokenization cannot exist without stablecoins. Like, they are one and the same thing. Because if you have tokenized the asset side, but you haven't tokenized the money side, it just doesn't work. You're not going to, the whole thing that Web3 gets you, what we did with Aberdeen is it gets you an atomic swap. So what we did with Aberdeen is we tokenized a money market fund, and then a company named Quantos, who's a MiCA compliant, regulated by the Dutch Central Bank, programmable euro. It's actually not a stable coin, it's a programmable euro, digital euro. What is interesting about this is the fact that you can trade instantly, where clearing is settlement. You can trade instantly a tiny sliver of that Aberdeen money market fund for a digital euro, and you're done. And so if one leg of that trade is missing, you don't have anything, right? So they don't compete so much as they, I think, are essential together to get the real benefit of Web3.
Right. And we've also heard about you know, the debate of what shouldn't be tokenized potentially. So would be curious to hear just from your experience, you know, maybe assets tokenized on Algorand with little volume, and you know, how you kind of expect some of those to evolve over time.
Yeah, well, what I think is super interesting about entrepreneurs is that they always find a way, right? So a company called TravelX tokenizes airline tickets, you know, and the relationship with your airline is terrible. You know, you want to return your ticket back, and you can only fly in a year. You get all kinds of penalties, and so they had this idea. Why don't we create a secondary market in airline tickets you can sell to somebody else? Okay, well, this is and you can, you know, if you're a frequent flyer, you can also, you know, give your lounge pass if you want to this person, right? And so, you know, you can imagine you're going to college and you buy your ticket home for Thanksgiving for 4 years to save money, but you don't actually want to go home 1 year, blah, blah, you can sell it. Well, you know, this market is not going to be very liquid. Like the number of people that want to buy my exact airline route on my exact day, it's going to be a limited number. This is not a deeply liquid market by any means. But the airlines, I used to always get asked, do the airlines like this or hate this? But it turns out the airlines just love this because they think of it now as a very easy way to take airline tickets back if they want. So your mother lives in Cincinnati and you are like a very good son. You bought a ticket way in advance to go to her birthday in Cincinnati. But you know, it turns out that your mother decided to go off with her girlfriends and do something like in the Bahamas, and Taylor Swift is doing a concert in Cincinnati that weekend. Well, it benefits everybody. You sell your ticket back because you don't need to go, and then that airline is going to turn around and sell that ticket for 5x because somebody wants to go to that Taylor Swift concert, right? So it's just making these markets a bit more efficient, even though the underlying market is not that. You know, a very interesting project we have going on in Italy with Enel. It's the second It's the second biggest utility in the world. Tokenizing solar credits, right? So it's the kind of the same thing. Why can't you get, and this is only enabled again in Web3, why can't you avail yourself of solar credits, right? What if you live in Ireland where it rains all the time? What if you live in an apartment building and you're on the 4th floor and you don't have access to the roof? You can buy an Enel solar panel, and that solar panel can be off in the field, somewhere where it's sunny all the time, and where Enel gets huge economies of scale because it's better to build a lot of solar panels together in one field than it is to put them on like one solar panel on one roof all over. And so, maybe the market for trading solar credits is not going to be that liquid, but it's still critical to have that tokenization because Enel, you can sell back to Enel if you don't use, all of your energy, you can sell back to Enel. It's tokenized, so it's just it's a very efficient way to do things, even when the market's not that liquid.
Yeah, and shout out to my mom in Cincinnati.
Yeah.
So you've told me that the tokenization can be the easy side. The tech side of tokenization can be the easy part. The regulatory hurdles might be the more difficult part for people looking to get into this space. So what might be some of the main hurdles for the players looking to get into tokenization and how they're kind of handling that?
Yeah, I mean, I think it comes down to the same things we've talked about for 3 days. So there have been some very good regulatory panels at this conference, I will say. There is this idea of, even though regulatory certainty is getting better everywhere, in the US thanks to the Trump administration, but Europe and the UK and Japan have all made great strides, the UAE. But regulatory harmonization, I don't think we're still there, right? And so these things move so fast that you do need some harmonization globally, and we're working on that. So I think that's quite important. I also think that the good things for consumers about Web3 is just how fast you can move your money, right? But from a regulator's point of view and from a bank, an institutional point of view, the ability that somebody can pull money out very quickly, we saw this with Silicon Valley Bank, right? That's terrifying, and that's also problematic for financial stability, potentially, global macro financial stability. So those are the kinds of things you have to kind of figure out. You got to make sure that your advances over here in crypto don't lead to unintended consequences over here, right? But I do think, though, that we have gotten a little bit of a bad rap from regulation, because the bottom line for me and for people in this audience is that crypto can enforce regulation. Smart contracts can enforce KYC. On Algorand, you turn everybody off. It's at the protocol level. You turn everybody off and you whitelist them one by one by one. It's very easy to do, but you have that kind of granular control. On Algorand, you can embed in the token, because we don't have like a smart contract layer, like a kind of an Ethereum model. It's all assets are in the base layer. You can turn on and off an asset. You can have a clawback feature in the assets. You can kind of whitelist within the asset. Now, before anybody freaks out, once you declare that you can withdraw, that you're not going to be able to claw back the token, you can't change your mind later. But up front, this token might be clawed back, or it might not have the ability to do that. So my point is that Web3 gives you the tools to enforce sensible regulation much more than traditional finance does. So the regulators, I think, should be taking a much more benign view of Web3, and I think they will continue to do that.
Yeah, and so just kind of a follow-up on that, what will it take for more traditional institutions to move on chain? You talk about some of the regulatory things you might be watching. We heard President Trump talk about calling on Congress to pass a stablecoin bill. So how do you think that kind of all works together to boost adoption there?
The bad thing about traditional finance is that they protect turf, like everybody does. The good thing about traditional finance, though, is that they love money.
Yeah.
And so we are going to lead, I think, probably with cost savings and better customer experience. And stablecoin legislation is going to be key to that. So I really hope we can get that done. The problem, though, even for the willing, besides like convincing upper management and all of that kind of stuff that they've been going through, and this point has been made in the past on this conference, but the hard part is kind of almost over now. We're in the hard part now. It will get easier going forward. But The idea with finance, though, it's very hard. It's so interconnected. It's very hard for one mover to move first. And so we have to reach a tipping point where everybody moves, because they're all these balance sheets, as I said earlier, they're all talking to each other. So I think we're a little bit like in this period now where we all have to kind of move forward together. That's going to be tricky. That's not easy to do.
Yeah, and we have a few minutes left. Would just love to kind of hear your thoughts on, maybe 5-10 years down the road. What sort of world are you envisioning in terms of how blockchain tech, tokenized assets are kind of integrated into everyday life?
Everyday life. Well, I think, first of all, the customer experience will be much more like their traditional finance experience. This, 24-word mnemonic or 12-word mnemonic, and the scariness of you're going to be able to pick to be much more easily in a custodial environment or a much more friendly Web3 environment, self-custody environment, and we will find things in between. So we're a proud member of the DREC Alliance with Cardano and Hedera and a number of others, where we're it's a little bit not quite custodial, and it's a little bit like not quite your, not your keys, not your coin, but we share keys, and it's a kind of a multi-sig approach. It's pretty interesting. So the industry keeps coming up with these new innovations, but I will say that what I think will happen is that traditional finance, every player will get tired and will no longer tolerate that their money is just sitting there doing nothing. This will not be acceptable anymore. When you hold collateral with your bank, and your bank is, of course, earning money on your collateral, but you're not earning money on your collateral, your initial margin, your variation margin, all of that, putting the ability to embed yield and with quick transferability, that combination is incredibly potent. And so I'll give you just one kind of far out example of that is I will take my Aberdeen money market fund, which is yield bearing, and I will go to your coffee shop and I will buy a cup of coffee with my tiniest sliver of my Aberdeen money market fund, and I will be earning yield until I hand this to you, at which point you will be earning yield on this little tiny piece. So, cash is an asset, apartment building is an asset, they're all assets. This continuum will get just completely blurred and more liquid, I think. That's my futuristic
yeah, and what might hold that up?
I think what could hold that up again is this. The coffee shop has to be able to take it. I have to be able to give it. There's just a lot of coordination in the beginning for this. But then once you get to this tipping point, then it will be explosive, right? I mean, you and I didn't imagine when we had our first interview that we'd even be here. That we'd even be here right now. Right. And so when we talk again, when I talk after the president again in 3 years from now, we're going to be talking about stuff that we didn't even think we would be talking about here, right? But it just we just have to kind of keep. We do a lot of work on education and a lot of work on global education. We are doing, payments into Afghanistan and now into Syria. And I think that these countries are also going to kind of leapfrog the traditional markets that we know in the West and the United States, because they get it. They understand that with digital payment, they don't have to wait in a super long line to get aid payments, right? They know that they can hold value in the US dollar instead of in their depreciating, highly inflationary currency, right? Aid agencies know that if they don't want payments to go to the Taliban, if they track those payments on chain, they can know that, and they can represent that to their own regulators. All of this, it's going to be a combination, I think, of entrenched players moving forward and the outsiders leapfrogging as well, and that's how we'll get to the promised land.
Yeah, thanks so much, Stacey. Look forward to seeing who your next opening act is. The president today, who knows tomorrow. And we have a great lineup of speakers coming up next, so thanks so much.
Thank you so much.
Please give a warm welcome to Michael Saylor.
Well, thank you, Blockworks, for hosting me. And thank you to everybody in the audience today for being here. I appreciate it. I've followed the program for the past few days. It's been extraordinary. And I'm happy to have the opportunity to present in front of you today. I have, could we go back one slide? I have prepared a new presentation. A few years ago, I created one called the 21 Rules of Bitcoin. This one's the 21 Truths of Bitcoin. And preparing for this, I asked myself, what is true today in the year 2025? And perhaps what are the truths that the mainstream world, the mainstream media, traditional investors, politicians, people that are just getting familiar with Bitcoin, with digital assets, what is it they don't know that seems very, very clear to me that I want to share? And so I've gathered my favorite 21 truths of Bitcoin today, and I'm going to start with the first. Bitcoin's an ideology. Freedom versus slavery, innovation versus stagnation, sovereignty versus dependency, property versus poverty. It's a very powerful ideology. It's spreading the entire world, and there would be no Bitcoin without the ideology. It's capitalism versus socialism. It's the individual versus the collective. It pops up throughout human history. We see these themes for the last thousands and thousands of years. You see these themes in the writings of the Austrian economists. You see these themes in the writings of Voltaire and the intellectuals of the 19th, the 18th, the 17th century. You even see these themes in the Constitution of the United States. The Founding Fathers had this ideology. And you'll see it echoing throughout Bitcoin. The second truth of Bitcoin is protocol. Satoshi created a protocol based on that ideology. The 21 million coins, the block sizes, the 10-minute centers, the SHA-256 hashing. It was an integrated protocol. It's not the only way you could have done it, you know. You could have base 10 math, but you could have base 2 math. You could have English as a protocol, but there's also French as a protocol. Bitcoin's a protocol for prosperity. It's a protocol for economic success, economic empowerment. And that protocol lives on in the software. Oftentimes people say, well, what about this quantum thing, or what about that technology thing? And the point that I make to them is that English language is a protocol. If you have to upgrade the software, you'll probably upgrade the software, keep the language. Base 10 math is a protocol. If you have to upgrade the software, rebuild the computer, you'll probably keep the base 10 math. Bitcoin is a protocol. You may change the hardware, you may change the software, you may change the nodes. The protocol is simple. A bunch of intelligent people everywhere in the world would like to keep their money forever. Once $1 trillion worth of money flows into that network, they'll be looking to figure out how to keep it. And then when it's 10 trillion or 100 trillion or 500 trillion, you'll have a bunch of people speaking a language of economics, a monetary language. That is the Bitcoin protocol. Truth number 3, Bitcoin's an asset. One of those 21 million coins pops out. A lot of people just focus on the asset. They forget the ideology. They don't really notice the protocol. They think, do I have a Bitcoin or not? What kind of asset? It's the apex asset. It's better than cheese. It's better than palladium. It's better than gold. It's better than silver or copper or land or goats or cattle or lumber or pieces of paper that we call currency. Bitcoin is the asset, right? It is the asset based upon the ideology and the protocol that results in the greatest monetary premium in the world. Truth number 4, It's not just an asset. Bitcoin's a network. Bitcoin is not just a network, it's the network. It's the most powerful computer network in the world. It's a global network. Without the network, you can't have the asset. The asset is stored in the network. The network is a manifestation of the protocol. The network creates decentralization, that's true, but it also creates fault tolerance, mission criticality, redundancy, and all of the other technical, economic, and ethical qualities of the asset and of the movement. An ideology that spawned a protocol resulting in an asset that circulates on a network. That would be a simple articulation of what Bitcoin is. It's a truth. I would hazard to guess that the great majority of people watching the price of Bitcoin don't think about all four of those things. And they don't think about this as much as they should. Bitcoin is immaculate. Truth number 5. It was spawned by the Immaculate Conception. A nameless, faceless programmer gave it as a gift to the world. How do you create an immaculate thing? It's a God-given thing. It's a natural thing. We've had it since the beginning of time. No one took beneficial claim to it. No one asserts control over it. No one expects to cash in on it. The Immaculate Conception is an extraordinarily important thing to the network. That, combined with truth number 6, Bitcoin is ethical. What makes something ethical? What makes it ethical is you can take title to it, you own it, no one can debase it, no one can take it from you, no one can corrupt it, no one can control it. It's a thing of natural beauty. No country will ever trust anything that another country can debase or control. No company will ever trust anything another company owns or controls. No person will ever trust anything controlled by another person. In order to reach this great plateau of ethical, it has to be beyond the corrupting influence of any human, any man-made institution, any organization of people in the world. The Immaculate Conception was a necessary condition, but the engineering brilliance of Bitcoin was another condition, right? Bitcoin's it's a perfect machine made of imperfect components. That's the brilliance of the engineering. Can you make something that can a human being make something that other humans can't corrupt? Bitcoin's ethical. Truth number 7. That makes Bitcoin a commodity. What is a commodity? An asset without an issuer. Gold's a commodity. Corn is a commodity. Lumber is a commodity. Why is this important? Because in law, commodities have a special status. A company in the United States can be capitalized on commodities. It cannot be capitalized on securities. There's actually a special carve-out in corporate law for publicly traded companies. But maybe more importantly, I can stand here and I can tell you that I think the price of Bitcoin will go to 13 million over 20 years. I couldn't say that about a security, right? You have legal immunity to actually express your opinion about a commodity. That makes commodities politically superior, legally superior, ethically superior, financially superior to a non-commodity, to a security. And it's not just a little bit better, it's 100 times better, right? And so Bitcoin is a commodity. Bitcoin is actually the commodity. I studied commodities in my early professional years. Every other commodity can be created with technology, with capital, with know-how. If you were going to take your family's life savings and buy a commodity to hold for 100 years, and you thought about it, would you buy soybeans or corn or oil or natural gas or lumber, coal, silver, Well, no, they're all awful, and you know why they're awful, because it's pretty obvious to you that 100 years ago it was harder to make those things than it is today. And if the price of oil goes to $1,000 a barrel, we're going to frack it, triple frack it, hyper frack it, and we'll drive the price of oil down. Same with gold. There's been hyperinflation in gold multiple times. You know, the California 49ers found gold. We created so much gold that we crashed the economy of Europe. Every other commodity is going to actually explode in supply with technology and with price. That makes them all garbage investments for a long-term investor. They're in fact the worst possible investments as a long-term store of value. The king of them, gold, still underperforms the S&P index by a factor of 2 or more. So there's only one commodity in the history of the human race that wasn't a garbage investment. The one commodity is Bitcoin, right? A digital commodity. And let's talk a bit more about that. Why is it not garbage? Why is Bitcoin great? Bitcoin is a digital commodity. Every other commodity I can name is a physical commodity. Physical commodities are God-given, and anyone in the world can create them. Digital commodities were created by the brilliance of human beings in a fluke. You needed to have a brilliant engineer, Satoshi, give away this gift to the world. The world needed to embrace the gift. The protocol needed not to be defective. And after many, many years of not knowing whether it was something or nothing, it spontaneously monetized and came to life. It really is a miracle of the 21st century. Why is a digital commodity important? Well, you can vibrate a digital commodity 60 times a second on a computer. You can move a digital commodity at the speed of light. The AIs can decompose and recompose a digital commodity millions of times an hour, simultaneously moving it and distributing it all around the world at the speed of a computer. Can't do that with palladium. Can't do that with gold. There's no way Apple Computer's ever going to ship an upgrade that has multi-factor authentication on a physical commodity. It needs to be a digital commodity, and that's what makes Bitcoin special. Not only is it a digital commodity, it is the digital commodity. The most profound thing that happened is 2 weeks ago, the president signed into law via the executive order, Strategic Bitcoin Reserve. David Sachs said, Bitcoin is an asset without an issuer, spawned via an immaculate conception. It is decentralized. We recognize it as a store of value. It is our digital gold. You have the most powerful person in the world and members of the cabinet that are saying that it's the policy of the United States government that Bitcoin is the one digital commodity in the world. That's going to ripple. And, you know, I can create a digital commodity, theoretically, an asset without an issue, and I can give it a protocol that inflates it 5% every year. I could create any kind of inflationary monetary protocol. For example, corn and oil are commodities. No one doubts the fact they're commodities, but they're not scarcity. They're not capped. Bitcoin wasn't just a brilliant creation of a digital commodity. Bitcoin was brilliant because Satoshi capped the supply at 21 million. If I give you an inflation rate of 2% and the supply of gold, the economic half-life of your wealth is 36 years. When I give you an inflation rate of 0% in your digital gold, the half-life of your economic wealth is infinite. It is forever. The difference between 2% inflation and 0% inflation is you're dead in 36 years with 2% inflation, and you live forever with 0% inflation. Next time someone tells you that it's just a little bit of inflation and the 2% doesn't matter, I just want you to think about that, the half-life of 36 years versus the half-life of 1 billion years. And of course, with that observation, it stands to reason. The next truth is Bitcoin truly is digital gold. Gold, what does it represent? Gold represents money and wealth in the human race for 10,000 years. It represents prosperity. It represents the king commodity. It represents the most ethical, virtuous, technically sound money. And the vast majority of the people in the world, they're not invested in digital assets. They're not invested in Bitcoin. They don't even know what we're doing here. You're probably, if you lined up 100 people on the street, to say that you're the top 1% is probably an understatement. You're at least ahead of 99%. So for the mainstream, when you say digital gold, what that tells them is that instead of giving away a gold medal at the Olympics, maybe it's time for a Bitcoin medal at the Olympics. What it means is that the golden age will give way to the Bitcoin age. What it means is a city with streets paved in gold maybe should be paved in Bitcoin. What it means is that if something is gold-plated, and that's how you monetize anything, a gold-plated lighter, a gold-plated pen, maybe it should be Bitcoin-plated, right? This is a very profound thing, right? The truth, Bitcoin is digital gold. We dismiss it as being kind of a boomery idea, but the boomery idea means Bitcoin's worth more than 20 trillion because that's what the gold is worth. But the truth is everything digital in our modern era is worth 10x the analog version. If Bitcoin is nothing more than digital gold, Bitcoin is worth $200 trillion if it's nothing more than digital gold. But of course it is more than digital gold because truth number 11, Bitcoin is digital money. JP Morgan said gold is money, everything else is credit. Money, a bearer instrument. I give it to you, I don't have it, you have the money. Well, Bitcoin is money. What is everything else circulating in the internet? Credit. What does that mean? It means that I send you something, I send you a fee over a credit card network. 45 days from now, maybe it will be transferred to your account after the credit card company takes 2%, right? In a world of digital credit, that means that it takes 4 years for the money to move 40 times, and at the end of the 4 years, all the money's gone. In a world of digital money, it means you can move the money once a second. Maybe you can move the money 60 times a second. You move the money 60 times a second for a 20th of a penny, you still have the money. The computers are not going to think one click, one settlement every 30 days. They're not going to agree to pay 200 basis points per vibration of the money, right? Digital money is profound. It's so profound that everybody in the business of managing money doesn't even understand what this means. When they understand what this means, then the industry is going to 100x. Bitcoin is going to go to the moon. Well, if Bitcoin is digital money, what else is it? Well, truth number 12. Bitcoin is perfect money. Okay? What is perfect money? If you read the writings of the Austrian economists, von Mises and Hayek, they write about money, but they couldn't conceive of perfect money. Voltaire, Aristotle, Plato, they couldn't conceive of perfect money. Why? They didn't have the technology. It's kind of like asking Aristotle, tell me about clean water. How do you understand clean water if you don't have a microscope and you don't understand that there are pathogens in the water? Nobody understood perfect money until Satoshi gave it to us, and that's because it was impossible to create perfect money before modern semiconductors, modern internet, modern cryptography. So they were struggling, and you can see Hayek and von Mises, they struggle with this notion. In the Constitution, the founding fathers, who were pretty intelligent, said, the only legal money in this country is going to be gold and silver coin. They kind of knew this idea, a commodity in your hand, a self-custodied commodity bearer instrument felt like good money. What they designated as perfect money in the Constitution, and we have drifted, a little bit away from that, they designated what they saw were the hardest commodities and the most liquid fungible commodities that could be used as a monetary token. And they were never perfect because you can't practically do every transaction by swapping gold and silver coins. And because gold and silver coins aren't hard capped, they have inflation. So they had defective money that was slowly decaying, that was not quite useful. but it was just, you know, they used to say it's the worst possible way to do it except for every other way, right? And so the significance of this truth, this basically marks the point where economics goes from being a superstition and an art form to being a scientifically based engineering discipline. You can't engineer an economic system or a monetary system before you have perfect money. It's just like trying to do good math, but 2 + 2 = 5 on Tuesday, and it equals 4 on Wednesday. And if you don't have stable numbers, you can't do math. And if you don't have stable money, you can't do economics. You know, if you can't drink water that's not going to kill you, life is pretty ugly, right? This is profound truth. Again, misunderstood. No economist trained in the past 100 years. They never took a course on perfect money. They never imagined it. But you can't really blame them. It's like if you went back to Voltaire and you said, okay, that's the smartest guy in the 18th century in France. And, you know, he wrote shelves of books. But like, you know, poke him and say, describe, you know, radioactivity to me. And how are we going to build mobile phones and satellite communications? And he would have thought, what are you talking about? Right? It's like the most brilliant person without the instrument, the technology, can't conceive of the rational thing. And that takes us to truth 13. Bitcoin is legitimate. A short phrase, a powerful phrase. It wasn't legitimate 4 months ago. A year ago, if you try to remember where you were and what you were thinking in March of 2020, when the entire crypto industry was under massive onslaught, everybody's getting sued, right? And the most likely future was everything gets ground into the dirt. We have completely come 180 degrees. This is the most powerful person in the world sitting in the most sacred place, the Oval Office, flanked by 2 cabinet members telling you Bitcoin is digital gold, a store of value, a commodity. Not just a commodity. You know, if the US seized 10,000 securities, all your artwork, all your houses, your planes, your trains, your automobiles, every currency, you know, everything of value, your diamonds, your gold brooches, your silver, they'd sell it. Right? The only thing the United States does not sell is its national parks, its nuclear stockpiles, and its Bitcoin. Now, that's a shockwave that will be heard around the world. That just happened, you know, literally days ago. It's going to take a while for that to ripple through the entire federal government. Then it will ripple through the state governments. Then it will ripple through the banking system, the insurance system, the credit rating agencies. Then it will ripple to all the banks in Mexico and El Salvador and Argentina and then Europe. It's rippling through the banks in Hong Kong and China and Japan and Abu Dhabi and Europe. How long will it take? Well, you know, how long does it take for a profound good idea to move its way through layers and layers of bureaucracy? It'll take a while, but the innovators will actually grab this, and those that need the money, that want the money, will reach for and embrace the money, and they will be enriched by it, and there will be others that will resist it. But that entire shockwave, right, that explosion in legitimacy, that happened just a few weeks ago, happened on a Thursday night in the White House. And that's profound. We are legitimate. And as I've said before, if Bitcoin's not going to 0, it's going to 1 million. Right? It's either nothing or it's something. And if it's something, then it's going up. And truth 14, Bitcoin is corporate. You know, I talked a little about corporate law. I'm very sensitive to it because I ran a public company for many years. We came public in '98. Every public company in the world is capitalized on one of two things. You're either going to capitalize on short-dated treasuries or sovereign debt, in essence currency, or you're going to capitalize on a commodity. Well, it turns out that every commodity other than Bitcoin underperforms the S&P index. It doesn't beat the cost of capital. So capitalizing upon silver or gold or palladium or oil makes no sense. There is one commodity that you can put 100% of a corporate balance sheet in. And that one commodity is a digital commodity, and that digital commodity is called Bitcoin. And so what does it mean? It means that for the first time in 100 years, companies can recapitalize, and they are recapitalizing. And what does that mean? That means a company starts by sweeping a little bit of excess cash, and then cash flows, and then it sells some equity, and then it issues some debt, and then another company follows, and another company follows. Right now, there's about 80 companies that are starting to buy Bitcoin, and there's probably 80 ETFs. We're going to see another one every week and another one every week, and pretty soon there'll be hundreds. And those hundreds become the gateways for hundreds of trillions of dollars of equity capital and fixed income capital to migrate into the entire digital assets economy. And you can see it right in front of your face. You see a company like Metaplanet goes from one hotel being worth a few $1 million to being worth $1 billion in 12 months. Where does it stop? It's not going to stop, right? If you're legitimate, you're corporate, right? You're going to see a transformation of mainstream organizations. The 15th truth, Bitcoin is global. Everywhere in the world I go, I meet someone, and they say, well, thanks because I bought a Bitcoin for my daughter, or I bought a Bitcoin for the family. We appreciate what you're doing. And you know what I say? I say thank you because I appreciate what you're doing. Bitcoin is global, Your Apple stock isn't. Your land isn't, right? The artwork that you hold isn't global, right? Bitcoin is a global asset. It means somebody in Nigeria buys it, and they're getting the benefit of entrepreneurs in Manhattan. And it means someone in Arkansas buys it, and they're actually in an economic relationship with somebody in Singapore, right? This is not a lowest common denominator thing. You own Arkansas real estate, no one's going to fish you out of that investment. You own Bitcoin, you bury it in your backyard in Arkansas, and you'll wake up in 30 years and find out that someone in Tokyo or London made you rich, right? This is the global asset. There isn't another asset that trades on Wall Street that is global in the way that Bitcoin is. And it's not just global, it's immortal. We're stretching in time and space. Show me an asset that stretches to every part of space that truly is global, Bitcoin. Now show me one that I can see into the next 100 years or 1,000 years. There's nothing else that you own that's going to last 100 years, right? Your warehouse will have to be redone. Your artwork will probably have to be restored, right? What company would you think is going to be around 200 years from now, right? The real beauty of Bitcoin is the elegance of the protocol is all you're doing is buying 1/21 millionth of all the money in the world forever, okay? When is that going to obsolesce? Like when are you not going to want to own 1/21 millionth of all the money in the world forever, right? It's not like iPhone 99. It's not like, getting the next upgrade on the whatever gadget, right? Bitcoin is immortal because the idea is so timeless and so elegant, and the network is just virally going to spread. It's a life form, and if it's immortal, it means you can actually think 200 years in advance. No company expects to live more than 10, 20, 30 years. Everybody's short term. It takes me to truth number 17 is digital energy. A calorie is organic energy, a Satoshi is digital energy. If you want the AI, if you want to put life in cyberspace, if you want to bring an AI to life, you have to imbue it with digital energy. Then it comes to life. Then it thinks. Then it lives. Then it procreates. Maybe it lives forever. You can't. Anything that is funded with digital credit is just a shadow. It's a shade. It's a ghost. If you want something to be a true life form, you have to put real energy into it. I've said many times before, Bitcoin is a conservative asset. I give it to you, I don't have it. It implements conservation of energy in cyberspace, but the more important point is it's going to bring life to cyberspace. Truth 18, if it's digital energy, then Bitcoin's a digital energy network. How do you move energy from point A to point B? How do you vibrate energy? Right? How do you do it in a rapid, at the speed of a computer rate? How do you bring the entire world into that relationship? You can't do it with a credit IOU, and certainly you're not shipping gold from New York to Tokyo in a second. Which takes us to truth number 19. If it's an energy network, Bitcoin is a digital economic system. How do you post $10 million for 5 minutes, with a company across the country and fetch it back? How do, vibration, how do I give it to someone, take it back in 18 seconds? How do I swap a capital asset for a currency asset? We see this in DeFi, right? I'm swapping Bitcoin for stablecoin for Bitcoin, but think more broadly, right? Think about a world of 1 billion robots talking to 1 billion AIs that are thinking at the speed of the computer, that want to actually transact millions and millions of times an hour in time and space. They're going to do it with a digital energy network. And that takes us to truth 20. If it's an energy network, I can reverse it. Bitcoin becomes a digital defense system. Bitcoin is the most powerful network. What's the unit of power? The exahash. If I actually place my cryptographic keys, my identity, my authentication behind that hash wall, behind that wall of digital energy, then I can secure a system, authenticate a system, defend a system, potentially even attack a system. You can't be a superpower if you lose control of your airspace. You can't be a superpower if you lose control of outer space. You can't be a superpower if you lose control of cyberspace. Control of the digital power network, the mining network, the hash network is control of the ability to move energy and capital from point A to point B. Control the network, control your destiny. Lose control of the network, you lose the ability to engage in digital commerce. Maybe you lose the ability to secure your cyber systems. It's a defense system. And with that, I'll end with my final truth, truth 21. Bitcoin is an emerging solar system. Everybody says it's a network, and then they go, yeah, I read something about Metcalfe's law. And Metcalfe's law is like knowing enough to hurt yourself. It's not a Metcalfean network. It's a Newtonian network. Bitcoin is an evolving network. Think a star system forming. There is matter, there is energy. It's the brightest thing in the financial universe. It's got a magnetic field. It is slurping energy, capital, into the magnetic field. There are objects in orbit. They're falling into orbit around it. All of you are in orbit around it to a certain extent. Every company, every country, every actor. It is getting more powerful. It will continue to get more powerful. It will continue to get brighter, right? A Metcalfean idea is like a little asteroid went past on the left and a white dwarf went past on the right, and they're both equal. Well, they're not equal. The white dwarf is going to suck the atmosphere off my planet, and the little asteroid is irrelevant. It's like a cute little shooting star. It made a little spark for me, right? This is not a little Metcalfean network. This is a network where when someone brings $1 billion to the network, it matters. When they bring 10 billion, it matters more. When they bring 100 billion, it matters more. The more capital, the more energy that flows in the network, the more powerful, the greater the gravitational field. Eventually, anyone in the orbit, right, has to adjust their trajectory in order to accommodate that gravitational field. You see this thing coming to life in front of you. It's going to have Newtonian dynamics, and it is an energy system emerging. And these are the 21 truths. Thank you for your time, and please go tell someone the truth about Bitcoin.
To join Michael Saylor in conversation, please welcome Pete Rizzo.
Michael? everybody. Welcome, or I guess welcome to me. You've been here. Michael, thanks for the presentation. Pete Rizzo, Bitcoin historian on X, host of the Supply Shock Bitcoin podcast for Blockworks. Michael, just want to jump in where you were in your presentation talking about we are watching history. This is a historic moment. The world is changing. We just saw a sitting president make an address at a Bitcoin conference, something that would have been unheard of even a few years ago. And today on the news, we have the Swiss National Bank making a statement about them not wanting to buy Bitcoin. We have Pakistan coming out forming a crypto council saying they'll be the leaders of Asia. So Michael, over to you. What is the risk here for nations that not just adopting a policy, that don't actually buy Bitcoin, don't start treating this asset as the commodity, the digital commodity?
Well, I'm an aeronautical engineer, and we design airplanes, and if you create a supersonic airplane, you create a shock wave. Supersonic means the plane is moving faster than the rate at which the air can communicate or get out of the way. So when something is moving too fast, you have turbulence, you have shock wave, you will have a lot of noise. What you're seeing here is the Bitcoin shock wave. This is going so fast, every actor, every money manager, every central bank, every politician is going to be asked the question, why don't you own Bitcoin? And that is indicative of just how much power they have. They're not being asked whether or not they're going to put cobalt in the Swiss National Reserves. But I think everybody with a pool of capital is going to be asked by activists in their own country, by activists in their own company, by their shareholders, why aren't you buying Bitcoin? And what you'll see is the world will bifurcate, right? You had an extraordinary, innovative moment in the White House a few weeks ago where what you saw was the president saying, we're going to embrace the future. And the president puts his finger on the world's first digital commodity and identifies it and says, this is not a bad thing, this is a good thing. We're going to own it. We're not going to sell it. We're going to get as much of it as we can get, right? That's a progressive move forward. I think you'll see that. You'll see other countries that will be regressive. I'm afraid of it. Why are you bothering me? You know, it's a nuisance. But at the end of the day, right, this is no different than embracing, you know, nuclear weapons or explosives or ships or airplanes, right? The powerful and the wealthy and the prosperous will embrace the new technology and overcome their fears. And the regressive will resist it, they'll fall behind, and they'll be impoverished by their lack of vision.
Well, let's talk about the how, right? So the Strategic Bitcoin Reserve is here. The talk now is about how the government would acquire Bitcoin in the United States and some of these other jurisdictions. What advice are you giving to governments out there that want to move fast, that don't want to be impoverished, don't want to have their citizens be left behind? How do they acquire?
Well, I think the first thing to do, which is what our government is doing, is build consensus and awareness. It's really important, right, first to identify Bitcoin's a commodity. It's very important to emphasize it's got an immaculate conception, there's no issuer. It's very important to make sure people understand it's digital gold. It's pretty important to understand it's an asset that will enrich us. If you don't get that consensus from the citizens, the taxpayers, and a bipartisan consensus, it's hard to move forward. And I think that they're doing that. So what's going to happen right now is, I think, a very elaborate and very thoughtful political process to build consensus. And consensus building is educating. We see that going on in DC. It's not going to be, I wouldn't be in favor of like one jolt, you know, trying to do everything at the same time, because there's that phrase, you know, if you want to go fast, if you want to go fast, go alone, but if you want to go far, go together, right? And what we need to do is make sure that we take everybody along, and that's going to be a dialogue between the White House, the Cabinet, Treasury, Commerce, the Senate, the House, the industry, and then all of the major political constituencies on both sides of the aisle.
Well, one of the big questions right now is really how much Bitcoin does America have? Senator Cynthia Lummis coming out and talking about this. We think the United States has 200,000 Bitcoin, but we don't know. There hasn't been an audit. We know that some of these agencies have been conducting sales as they have been historically. What is the impact here if the United States has less Bitcoin than we think we have? What if we don't have 200,000 Bitcoin?
Well, I mean, the only thing we know is we don't have enough, whatever the number is. I think that we'll know more with more transparency in time, especially this year. I think that we'll put in place pretty good programs for managing digital assets, for managing Bitcoin. Certainly, I think by the end of the year, based upon everything that the president has said. I think that clearly the opportunity is that there's $450 trillion of long-term capital in the world, and it's all invested in 20th century bonds, 20th century real estate, 20th century equity, and 20th century artwork and other collectibles. And as the world gets educated, they're going to sell their inferior assets and they're going to convert them into Bitcoin. And the Bitcoin network is going to grow from 2 trillion to 20 trillion to 200 trillion, and then it's going to grow beyond. So the opportunity is buy cyberspace, buy Bitcoin, buy a share of the digital capital of the world, and then let all of the capital from the rest of the world flow into the network and enrich you. Capital from the 20th century in the US. I mean, someone with a warehouse in New Jersey, when it gets to the end of its life, may very well say, instead of renovating the warehouse for another 20 years, I think I'll sell it and buy Bitcoin with it. So 20th century capital will flow into the Bitcoin network, foreign capital will flow in the Bitcoin network, and then these AIs and technology companies are going to create tens and then hundreds of trillions of dollars of value. It will flow into the Bitcoin network. So the opportunity is simply buy it, buy as much of it as you want to own, and then allow the passage of time to enrich you. And then I think the threat is, right, the risk is, don't buy it. How would you feel if your enemy made $80 trillion and owned the network or controlled the network? The worst case would be they make 80 or 100 trillion, they control the network, they own cyberspace, you don't. And I would say the best analogy, and this is manifest destiny in the United States. When Thomas Jefferson was president, he had an opportunity to buy Louisiana. We didn't have the money, but it's not that complicated. You're on the East Coast and you look west and you think, do I want to allow the French, or do I want the French to sell this to the British, or do I want it to be sold to the Spaniards, or do I want to own it? So we bought it, and then we moved on to take control of and take ownership of Texas, and then the West, and then California. And where would the country be if California was owned by the Spanish and a third of the country was owned by the French, and we had been responsible in not taking risk? And so the answer is, it's the future, right? You may not, you could say, well, I live in New York City. I don't think anybody will ever want to live in St. Louis or San Francisco or LA. It's like a hard wagon ride from here. And you would be right, but you would be wrong. Of course they want to live in San Francisco and LA. You just got to look out far enough. And I would say, I think people in this room know this, but the average, the normie would say, well, wait, I can't live in cyberspace. I can't live in a digital energy network. It's like, well, maybe you can't, but the AI can. The thing that you create that's going to take responsibility for all your family's money, that's going to make you rich, it will live in cyberspace. It will look at you and say, are you crazy? I can do things 1,000,000 times a second perfectly, 1,000,000 times more efficiently there. But you want me to actually, trade copper tokens, at the speed of sound or something, or less than the speed of sound. So the future is there. The economy is going to go there. You can buy it. You can buy it for a nickel. You know, we bought 80% of the United States for $40 million, 80% of the country. And I think there's an equivalent opportunity right now with Bitcoin. So it's something you do it either because it's a good opportunity, or you do it because you wouldn't want your worst enemy to do it to you.
Right. Well, you put a number on the goal you have for the United States. You'd like to see the United States own 5 million Bitcoin, about 25% of the network. Do you have a sense then of how much of the Bitcoin supply could be owned by governments? If like there's a geopolitical order that comes around Bitcoin, how much of the supply would be owned by just the totality of governments?
Look, I think Bitcoin is perfect money, and it's the most profound opportunity of the 21st century. And the rich, the powerful, the comfortable, and the arrogant have no need for it. So I think the most beautiful thing about Bitcoin is it's money there for the taking. If you want money, if you need money, if you're willing to take the risk, if you're at the beginning of your life cycle, if you're in your youth, America was a youthful country. If you're a youthful person, a youthful family, a youthful company, if you're an ambitious country, then it's there for the taking. I can't really tell you, I mean, and the beauty is Satoshi gave sovereign money, which means that the rights of a cab driver in Nigeria are just as powerful as the rights of the United States, you know, in Foggy Bottom. So will the Bitcoin be claimed by individuals? Will it be claimed by corporations? Will it be claimed by nation states? Will it be claimed by institutions? And the answer is, I don't know, and I think that Satoshi just kind of gave perfect money to the world. Those who can overcome their arrogance, who need it, will see it for what it is, and they will claim it. And then others will be comfortable in their 20th century existence, and they will dismiss it as a nuisance. And, you know, I've said sometime before, the volatility of Bitcoin is a gift to the faithful. The complexity of Bitcoin is a gift to the faithful. Because if it was simple and if it was non-volatile, someone with more money than you, that's arrogant, that doesn't need the money, would have it all, and you would have none of it. You would have no opportunity. So I think it's in everybody's best interest that it remain a little bit complicated, a little bit volatile, and then the greatest nations of the 22nd century will embrace it. I mean, there was a time when the Chinese outlawed explosives and gunpowder, and the Japanese thought that was a good idea too, right? And it lasted for a while until people that thought that explosives and guns and gunpowder and technology were an okay idea showed up and made them change that. They toppled the governments, and they were dragged kicking and screaming into the 20th century.
But I guess, is there a number that, you know, scares you or might worry people? Because there are people who are worried about how much government involvement there is now in Bitcoin. So is there a number that there is no number, it sounds like, that changes how you think about Bitcoin in terms of how much governments could acquire, with, you know, China now looking maybe to respond to the US?
I put my trust in Bitcoin. I think that Bitcoin is going to evolve in a very dynamic, very healthy fashion, because it's the most ethical, the most open, the most ethically sound, the most powerful idea in the world. There's going to be nation-state struggles, but it's possible all nation-states ignore it, and it's companies that fight over it. It's possible that companies ignore it, and it's the individuals that fight over it. But I think I mean, I talked about ideology, right? Bitcoin is the triumph of the natural law over the artificial law. It's a triumph of the natural versus the artificial, right? And natural law says what naturally should happen will happen. And those that are arrogant and foolish will dismiss it, and they won't benefit from it. And I think that, as, you know, the question is, am I worried that the US won't embrace it? Or am I more worried they will embrace it? The truth is, if the US embraces it, it will inject virtue and natural law, you know, and respect for property rights and freedom. and economic balance into the U.S. government. So I think any organization that embraces Bitcoin is made more virtuous, made healthier, and made more rational. And I think in that way, I don't really worry about, it's like with banks, right? Am I worried about banks embracing Bitcoin? No, the banks would be more rational, and they would be more equitable, and they would be more ethical, and they would be more secure and probably better actors if they embrace Bitcoin.
Well, certainly there's a lot of organizations here. I want to call back a few of your recent statements and just talk to the startups and kind of innovators who are in the audience about what opportunities you see. Obviously, you delineate between Bitcoin and the crypto ecosystem beautifully, but recently you've said that you see digital currency as being a $10 trillion opportunity, digital securities as a $10 to $20 trillion opportunity, and then digital tokens as a $10 trillion opportunity just for America. In the past, you've maybe been more critical of these projects. Can you talk about what opportunity that is? What is that opportunity, and are you interested in it?
Yeah, I posted this on my X profile on highlights under a digital asset strategy, which I presented to the president in the White House a few weeks ago. I think that the great opportunity here is to define an asset class, the digital token, and I think the digital token ought to be an asset with an issuer that has some utility that stops short of being a security. And if that's the case, why can't 40 million businesses issue a token with some utility to create capital? I think digital tokens for capital creation and for innovation. And as long as you're civilly and criminally responsible for the damage you do, as long as you don't lie, cheat, and steal, I think that there ought to be a massive token economy that explodes. That'll get us to 10, 20, 30, 50 million tokens, and many will fail, but some will succeed, and then the world will get very interesting. I think that the brutal fights over the last 4 years were because we only had securities and commodities. I think that that's a false dichotomy, and there will always be confusion and controversy until we create a new set of assets. The digital token ought to not be a security and not be a commodity. It ought to be an asset with an issuer. And if the issuer takes responsibility for creating utility and for not lying and cheating and stealing, then you've unleashed the opportunity for 400 million businesses to raise capital and innovate. I think digital currencies ought to be designated as such, which is an asset with an issuer backed by currency. And I think that should be a competitive market. And I think that if digital currencies become competitive, I think things like the dollar will spread to be a $10 trillion asset. Right now, Tether is successful offering zero yield, and there's 150 billion of demand for it without being endorsed legitimately by the U.S. government. If the U.S. government let a bank offer you a digital currency that gave you 400 basis points of yield, the demand would go up by a factor of 100, right? And the big winners would be the U.S. dollar and the issuers, and then most of the weak currencies will be replaced, and the U.S. will export its currency to the world. And I think the U.S. can export $10 trillion of U.S. dollars, but it has to take the AML, KYC friction off, right? It needs to be a digital currency that we can trust, that moves at the speed of light and vibrates 1 million times a second and goes through 100,000 layers in an hour. That's what's best for the U.S. dollar, and that's what's best for the economy. And if you take that same idea to securities, why can't you tokenize Apple stock or a share of ETF? And if you do that, we will export trillions of dollars of our securities to the world, and then people will start to create intricate instruments to tie currencies with securities, with commodities, with tokens, and then you'll see $100 trillion of value created through innovation.
Well, winding down here, talking again about this currency, securities, tokens aspect of your framework, are these opportunities for strategy? Who are these opportunities for, and then who can gain from these opportunities in your view?
I think there's 400 million companies that would like to raise capital. I think the token is an opportunity for any company that ever wants to raise capital or create something new and innovative in cyberspace. I think that the digital currency opportunity is going to be for regulated banks and big corporations that are, that can file audited statements and get the trust of the financial regulators. I think digital securities, any company that could issue a security might get into that space, but it's like for the ETF providers and companies that are regulated entities. So, what I see is Bitcoin as the king commodity. I see 100 digital currencies. I see thousands or tens of thousands of digital securities. And I see millions and millions of tokens circulating, all of them on 24/7, 365 crypto exchanges. And all we're waiting for is that digital assets framework to be written into law by the President of the United States. When that happens, there's a Cambrian explosion of all these assets, and it'll start in the US, it will ripple out to every other country in the world. Everybody will copy the US. And if the US does it right, then all the entrepreneurs and all the capital will come to the US. And of course, that's the vision of the Trump administration and this industry.
Final question, Michael. You talked about the 21 truths. Are there still things that you're learning about Bitcoin yourself personally?
Every single day, I'm learning something new and elegant and beautiful and wonderful about Bitcoin. I think we'll never completely understand it, and it's like the mysteries of the universe unraveling themselves to an astrophysicist. It's a lovely endeavor.
Michael Saylor, Executive Chairman of Strategy. Thank you all for watching.
Let's give a warm welcome to David Rodriguez and Solomon Tesfaye.
Give it a minute. All right, everyone, good afternoon. My name is David Rodriguez. I'm the head of Blockworks Advisory, and I'm joined here today by Solomon Tesfaye, who's the head of capital markets at Aptos Labs. Thanks for joining.
Pleasure to be here.
Before we jump to the list of questions, talk about how tokenization unlocks new use cases for real-world assets, we'd love to dive into your background at Aptos Labs, and even further, you've been doing this in this industry for a minute, so we'd love to hear more about your prior background.
Absolutely. First of all, thanks for joining. A tough act to follow. So as David mentioned, I'm Solomon Tesfaye. I'm head of capital markets at Aptos. Aptos is a large layer 1 blockchain, move-based blockchain. Actually originated within Meta's Libra blockchain program. And so in terms of my background, prior to this role, I worked at a company called T0 in a very similar capacity, where I was head of capital markets and business development. T0 was one of the early entrants within the space of tokenization of real-world assets before it was actually called real-world assets. I've seen a lot of different acronyms over the years. That particular business was very vertically integrated. It had a number of different broker-dealers, placement agent, alternative trading system, transfer agent, retail brokerage firm, and then of course a tokenization engine. So we were blockchain agnostic, and then my background before that's very traditional finance within investment banking and venture capital.
Awesome. So before we jump into some questions, could set the stage. RWAs and tokenization more generally, is a really big narrative. I think probably like 30% plus of all the topics that we've discussed here at DAS so far the past 3 days has been centered around this concept, and for good reason. I looked just yesterday, there's over $19 billion of total assets issued on chain today. It's grown about 30%, 25 to 30% over the past 30 days alone. And year over year, you're seeing probably like 30 to 50% CAGR. But at the end of the day, it is still a drop in the bucket. There's over $100 trillion in the capital markets that we are trying to bring on chain over the coming decades. But there's a lot of good reason to be excited about this new vertical. There's a lot of promising signs. But with that being said, we'd love to learn, what do you see as the most transformative impact that tokenization has for TradFi institutions coming on chain?
I think it's really just access. When you think about just the world population, 85% of the world population really doesn't have access to traditional financial services. So I think just access, whether it be to USD through stablecoins, or whether it be access to different financial services, microfinancing, portfolio management, and so forth. It's really going to be the main, I think, driver and exciting part of the applications of blockchain overall.
Cool. When I was looking at total assets issued on chain, again, it's around like $19 billion today. 67% of that is private credit. I believe, and talking non-stable coins, obviously stable coins alone is like a $250 billion plus market. 67% of all assets issued on chain are private credit. I believe that there's like 20% is commodities, and then I'll bucket everything else under other for now. What is it about private credit that has, I think, driven its market dominance on-chain asset issuance? And is there, a follow-up question to that, is there an asset class you think has surprisingly been a lagging asset class in adoption?
Well, I think just given the momentum we're seeing on stablecoins, I think that kind of the next evolution is kind of really like microfinancing, and then also the industry's emphasis on yield right now, fixed income kind of is a natural play. So I think even when you think of Aptos, right now we're right around third or fourth from an RWA.XYZ ranking perspective in terms of RWAs on chain. Private credit definitely is the major driver of the kind of the momentum we're seeing. And so it goes back to areas I'm most excited about when you think of like microfinancing and what that implies in terms of access to capital globally. I think you're going to see more yield-like plays come on chain, and then you'll start to see more equities. Equities were first the leading indicator in 2018-19 in terms of people pursuing that, and for a number of different reasons, mostly mark-to-market of equity, that subsided. And then I think now private credit and fixed income just more holistically is going to be the driver for the next at least 5 years, and then you'll start to see kind of more esoteric assets much further along.
So you touched on it about Aptos' like rise to prominence in like the RWA vertical. I would say maybe 6 to 8 weeks ago, you had a pretty big announcement with Pact, bringing $1 billion of RWA issuance on chain. Like you said, already making Aptos probably second or third largest chain by RWA issuance. We'd love if you could peel back the curtain on like what is, if you could elaborate further on that Pact partnership, maybe even other potential partnerships you have coming down the pike.
Of course. So Pact is a team that just continues to execute. Pact, just to give you some context, does on-chain lending and securitization. They're focused on microfinancing within emerging markets. They partnered with strong lenders and originators like LendingTree and Branch to really gain scale quickly. Over the last 2 months, they put $1 billion of total assets on chain. They've also put about 250 million of active loans on chain. They have access to already 20 million plus accounts. So this is an example of a business that's actually solving a real need. Talked about the lack of access globally regarding financing or financial services more holistically. And then at the same time, this is a team that's actually worked with traditional players to bring assets on chain so they can gain scale. Because right now, distribution is extremely weak when it comes to any application within RWAs. And then even further downstream, that has, of course, a very meaningful impact on any type of secondary dynamics because, of course, in absence of having strong primary markets, you're not going to have strong secondary markets. And then I think there's a second part to that question in terms of what's to come.
Yeah.
So you'll start to see just a kind of a broader breadth of products. I mentioned that for the foreseeable future, we think it's going to be more yield-oriented products or products that tend to be very, very liquid products that are good sources of collateral. That's why we've seen a lot of momentum on the money market fund side. But I think that's what you're going to see in the short term. And then I think you're going to start to see a lot more traditional products come to market outside of these two areas. And then you'll start to see a lot more breadth in terms of a wider variety of products that we're all kind of excited about, whether it be equities or whether it be very, very esoteric products like I know a lot of people are excited about like art and music royalty streams and things along those lines. But even in the traditional markets, those are very negligible in terms of distribution. So I think those are much further downstream.
Got it. We'd love to lean into your past experience at T0 because they were definitely like a pioneer, I would say, in this vertical. Over the past 5 or 6 years, infrastructure has been a big I would say area of capital allocation from a VC perspective in the industry. Over the past few years, we've seen really the growth of the high-throughput blockchain. Back when T0 was a major pioneer here, back in 2019, you really only had a few select chains to choose from. Not high-throughput, high base or high transaction fees for end users was probably like a barrier of entry for TradFi institutions to come on chain. But obviously, chains like Aptos, where you have 150 millisecond block time, sub-cent base fees, that has to be like a really good, interesting angle as you talk to some of these TradFi institutions as to why Aptos is a great place to deploy their assets on chain. how has like the conversation, I think, has it changed over the past 6 years from your time at T0 to today? Like, are the friction points today the same that they have, are the friction points they had back then the same that they have today? Or is it a completely different conversation just because of how much more mature the infrastructure is become?
So a lot to unpack there. So on the front part, on the T0 side, I think we were definitely ahead of our time, right? T0 was definitely one of the first entrants in the space, extremely vertically integrated. I was fortunate enough to have worked on a lot of the higher profile RWAs at the time, from the tokenization, which we were blockchain agnostic, to primary all the way through, of course, secondary. The emphasis on secondary that early in the life cycle, because I mentioned earlier, primary has been so weak, there was just less opportunities. And then if you look at the US, if you do a typical private placement, tokenized or otherwise, there's a lot of implications around lockup periods and so forth before you can actually even capitalize in secondary. So I think that emphasis on secondary that early on in this kind of industry probably was a little bit too early. And then in terms of kind of basically friction points, I think also there was lack of assets, right? There's just lack of assets that really were pursuing that at that point in time, mostly middle market and below, and a lot of them were also at the beginning were residual from like the ICO days, so the asset quality was not necessarily great. People thought they could tokenize a particular asset and suddenly it changes its intrinsic value, or suddenly it's going to contribute to distribution or secondary trading, which is simply not the case. And so I think a lot of these dynamics also basically were the kind of the reasons why there was slow momentum on that side of the house. And then in terms of just kind of, if we look at current times, kind of roadblocks that may have been roadblocks, not roadblocks before, or vice versa, roadblocks before that are not roadblocks now. Historically, there was infrastructure used to be an issue. That's no longer an issue now. Now we have a surplus of different infrastructure providers, whether it's custodians or other broker-dealers and so forth. Then distribution, that continues to still be an issue on the primary side. Regulatory line of sight, that's of course now we at least are all optimistic in terms of the direction that's heading in. And then outside the US, like in Asia and so forth, there's been line of sight for some time. So I think a number of the different roadblocks are being addressed, but still when it comes to distribution and it comes to just asset quality, asset breadth, there's still some issues that need to be reconciled, that will be reconciled over time.
What are the drivers for institutions coming on chain? Like what? At the end of the day, we're all here to talk about like what is the power that tokenization unlocks? Like, is there something that is a recurring theme in these conversations that I think gives them that light bulb moment? Be like, yes, I need to do this. This is the future because of X, Y, Z.
I think I really put it into like 3 different buckets as of now. Of course, there's a lot more different, unique scenarios, but really it's one, they're either looking for greater distribution. They're trying to tap into basically on-chain capital that continues to grow. When you think of like BlackRock with their Biddle fund, Franklin Templeton with their 40 Act fund, Apollo with their diversified private credit fund, these are all products that already exist. They're just trying to grow the pie, if you will. And then that's basically bucket number 1, just at this point in time, greater distribution. I would say the majority of the counterparties first, at this point in time, fit into that bucket. The next bucket is, basically streamlining back office, basically a friction, whether it's operational or administrative, and they're looking to leverage technology from that perspective. That's had, at this point, because there's some duplicative processes as different firms to try to gain regulatory clarity. That's probably the next biggest bucket, but still not the driving factor just yet. There's a lot of pilots to basically reconcile and test that validity. And then the last bucket, which is further downstream, would be I want to offer very unique products that blockchain enables. And I really want to capitalize on basically growing the pie or the suite of different offerings in the market.
I want to double click on that last part. I'd love to hear from your perspective. Like, is there some examples of like new financial primitives, new structured products that you think are going to be come on chain and be unlocked because of the composability, the global liquidity demand, the ability to fractionalize ownership, all this? Like, is there something that immediately comes to mind, or maybe again like a recurring theme that maybe has been some of the conversations you've had with some of these firms?
Yeah, I think from talking to different folks that are really trying to make a dent on the derivative side, I think a lot of different counterparties that historically had not made very, very complex products because just administrative hassle would be daunting, are looking to blockchain to solve that. They like the fact that they utilize smart contracts to enforce certain guardrails, if you will. And so really it's around how exotic they want to make the particular product. Also, when you think of like simple things that do exist, but they don't exist on the secondary side, like tokenizing royalty streams. people like the fact that they can monetize their P&L in that capacity as well, as opposed to just looking at it from just simple equity or debt.
Gotcha. When do you think you're going to see us do away with like dual ledgers? You talked about all the back-end admin. The reality is right now, like every single asset that's on chain is also sitting on a ledger at these individual institutions, and right now there isn't cost savings. If anything, it's a cost adder, I'd have to imagine. How far away are we from like natively on-chain asset issuance?
Yeah, that's why I downplayed that second bucket around streamlining at back office and so forth at this point. I think it's just iterative. Right now, all the institutions are testing out the technology, getting comfortable with it, setting up the guardrails, and then over time, it will be the source of truth. Because when you think of just inherently what blockchain brings to the table, it overlaps significantly with like cap table management and transfer agent capabilities, right? So the fact that you have two ledgers, and we dealt with this historically even at T0, it was just certain counterparties needed that dual ledger in order to interact with us, whether it be from an issuance perspective or whether it be from a partner perspective.
Do you think technology needed to like do away with dual ledgers, is that going to largely come from these TradFi institutions building products on top of like a chain like Aptos, or is it actually going to be like first-party products coming out of like the Aptos labs or some of these other like lab entities?
I think just from a scale perspective, it won't necessarily be products that Aptos or a layer one produces. It's going to be working with issuers on product, and then whether it's sitting at the issuer level or whether it's sitting at a TA equivalent or fund admin level, they'll be the ones that are putting the assets on chain or issuing the assets natively on chain. But I don't think it's necessarily going to be from products that Aptos issues. Also keep in mind that, of course, like all layer ones, we don't have the appropriate licenses, broker-dealer license domestically or within all these different jurisdictions. So we're not also doing any kind of placement agent activity or secondary activity, but it will be most likely partners that we work with.
Got it. Where do you see like tokenization going over the next like 5 to 10 years? Is there something that you're really excited about? Obviously, I know you've like hammered home the point about like microfinancing, things that like these high throughput, low cost blockchains enable. Is specifically that, the democratization of like of finance, and so especially like a lot of developing and emerging markets. Yeah, I mean, I'd love to like hear from your perspective, like where do you think the next 5 to 10 years look?
So maybe a kind of a rapid fire set of different things I expect to see. One, I expect to see a lot more M&A. It was good to see, Kraken's announcement.
That was really cool.
Trader this morning. I think there will be a lot of M&A between just basically broker dealers and crypto counterparties, or vice versa, as people look to just basically offer both native blockchain products as well as traditional products, and hopefully there'll be that convergence. I think there'll be more crypto-linked products, like we see with kind of the ETFs as well as the ETPs. I think in general, I think over the next like 5 years, you'll just see a lot more traditional products get put on chain, like just like we see with money market funds, fixed income, and so forth. And then the value add there's going to be an emphasis on fractionalization. So they're going to give products that were maybe once reserved for a larger check size are now going to be broadly accessible. And then hopefully within the back end of that 5 years, you'll start to see a secondary market start to evolve to some degree, where some of these products actually give you that secondary optionality, which I think is going to be a catalyst, of course, for distribution, because now I'm investing in a product that I otherwise would have to hold, and now I'm able to invest in like a private credit or any private equity, whatever the case may be, and know that I have some option to kind of walk away from the table, not just get democratization to access the asset, but also to be able to walk away from the asset. And that's very important when you're dealing with a demographic like the retail or whatever the case may be that need that optionality.
What do you think, like forward-looking, like the bifurcation of the on-chain economy? Like largely speaking, it's been largely permissionless capital formation, crypto-native assets. I think, like largely speaking, the growth is going to be from these off-chain assets coming on-chain. It's an interesting dichotomy of like permissionless chains, but also like permissioned assets coming. I'd love to hear, like, do you think the on-chain economy is largely going to be like more bifurcated over time from an institutional, like a retail perspective?
I don't think it'll be more bifurcated. If anything, I think if it's like a Venn diagram, I think it'll be a little bit tighter.
Okay.
If anything, I think there will be assets that are permissioned and ones that are permissionless, and then there'll be permission assets that may have derivatives that may be able to interact with the permissionless world, which we see with like Securitize as BIDL, and then they have SBIDL, which are permissionless, right? And so I do think there'll be variations like that that kind of cross both directions, but it's going to be up to the issuer.
Right.
The issuer at the end of the day knows their commitments. from a regulatory perspective, and they'll know what is permitted, and then they'll try to push those boundaries. But I don't think it'll be further separated. I think it'll be closer to one another.
Got it. I think I have one final question. It's like, what asset class do you think is going to see like the most transformational change due to tokenization?
Probably, cash and cash equivalent. I think that's I think the common denominator across all the different asset classes, right? Right? We always at Aptos pride ourselves with being able to support the fastest dollar in the blockchain environment, whether it's USDC or USDT or any of the other stable coins that we support. I think that's, once you start there and you actually can give greater access and greater efficiencies around money movement, then you're able to, of course, go into a lot of other variations, other product types and so forth. But I think it has to start there.
Awesome. I know we're coming up on time. I don't have any other questions, but Solomon, it was a really great job with you. Thank you very much.
My pleasure. Yeah. Thanks for your time.
Talk soon. Thank you, guys. Thanks, Solomon.
Please welcome to the stage Miguel Morel.
Hi, good morning, everyone. Thank you all for coming. We're super proud to be sponsoring the conference with so many great visitors and so many great guests. Today, I'll be talking a little bit about my company, Arkham Intelligence. So first of all, what is Arkham exactly? What is our vision? What we've wanted to implement within Arkham has been an on-chain analytics platform that is focused on bringing trust and transparency to the cryptocurrency ecosystem. Now, how exactly have we managed to do that? We have done this by building one of the world's best blockchain analytics platforms focused on the de-anonymization of cryptocurrency addresses, and namely attempting to put an identification behind all of the major wallets across the world, across a variety of different blockchains. This has led to a large number of traders, different kinds of institutions, be it regulatory or financial, coming to Arkham in order to get information about what all of the world's traders are doing. Who are the people who are buying and selling cryptocurrencies, for example. And in this comes a major opportunity for us to fulfill an even larger vision, which is having a centralized place where people are able to come to understand what's going on in the crypto market, look at our analytics, and ultimately be able to place trades. So let's go through a little bit of the information about Arkham Intel. There are many people who have maybe seen us on Twitter or potentially even used our platform, but don't necessarily understand the scale or breadth of what our platform can do. Many traders or different researchers or even journalists have used Arkham in order to try to understand the different people operating in the cryptocurrency space. As far as the actual numbers, we have labeled over 1.9 billion addresses, or we're close, likely within the coming days, to come to over 2 billion addresses on the blockchain labeled. And while that's important, an even more important figure is the amount of volume that has actually been labeled by Arkham Intelligence. And this is about 78% of all transactions have been labeled with one of the sender or the recipient of the transaction having been attributed by our platform. From these 78% of transactions, this is equivalent to something like $385 trillion of blockchain data that have been labeled by our platform. Now, how exactly does the Arkham platform work? Many people have sort of been mystified by our technology and the ways in which we've managed to be able to produce so much information and labels about what's going on chain. We start similar to everybody else. We have managed to run our own data infrastructure in order to get information from the blockchains directly. And this comes to us in the form of pseudonymous information and addresses, raw data directly from the blockchain, which is incredibly difficult to use and very difficult to search. So while blockchains by default are very transparent and auditable, you might not actually know what you're looking at. All you see is a string of hashes of people sending money between one another, but you have no context on who those people are. Are they individuals? Are they institutions? And what are they moving the money around for? So we take all of this information, and in order to synthesize it in the most helpful possible manner, we bring it to our engineering and data science teams, and with some of the research and development that we've done internally, we are then able to categorize the different addresses, show entity classification. So this means actually taking the addresses and figuring out the clusters of who they belong to and which ones are actually closer together versus farther apart. Using publicly available information and metadata in order to then classify the different addresses. You know, is this an exchange? Is this an individual? Is it a trader? Is it a fund? Is it a market maker? And then using different types of machine learning and other sorts of data science tools in order to then actually have the identification. This then gets uploaded into one single platform, which is the Arkham Intel platform, where you have all of the de-anonymized cryptocurrency users in a single place, which is searchable via our database. And for those of you who are using our platform in a more sophisticated manner, you can use our API in order to do this at scale. Now, what does having a database of all of these different users within the cryptocurrency industry actually entail? What can you get out of it? Once you've managed to build and collect all of this information, what as a trader or as a researcher or journalist are you actually able to do? Well, for starters, having a collection of all of the addresses of a particular entity gives you a sense for their portfolio. It shows you what their current holdings are, but also, given that the blockchain is immutable and forever, allows you to see what they've also held in the past. It allows you to see this across every major blockchain that we support, not just Bitcoin, but Ethereum and Tron and Solana. And as the industry continues to develop and people continue using more blockchains, either layer 1s or L2s, gives you the ability to have a holistic picture of their positioning across the entire cryptocurrency ecosystem. Whereas if you're just looking at a single wallet on a single chain, you might not have the entire picture of what exactly they're investing in. And across all of these things, of course, you can then get an understanding for how big of a position they have on chain. You know, is this a whale or is it somebody who's significantly smaller? But bringing all these pieces of information together across all different blockchains and addresses gives you a much better sense for this information. Bringing it to a much more granular level, we're able to look at the exact transactions that are being made by the entity, institution, or individual. We can analyze their top counterparties. We can visualize a network of everyone who they've ever sent funds to. And we can see what sorts of exchanges or services they're using. This can be particularly important, for example, in cases of hacks. In the case of the Bybit hack most recently, people have been using the Arkham Intelligence platform in order to visualize and assess exactly what the Bybit hacker has been doing with the hacked funds and tracing those funds across blockchains, in most cases Ethereum and Bitcoin, to actually understand where the funds are going and how the funds are actually being laundered. Once you have all of the information about the transactions and their portfolio, this then gives you another layer of information, which is the cost basis of the person, their daily profits and losses, as well as their cumulative profit and loss. And this gives you a sense for example, how good of a trader a particular entity is. Maybe that's somebody who you might want to copy trade or try to understand more about what they're doing because they can move markets, for example. And this all leads me to a new paradigm that has been created by the emergence of not just Arkham, but the on-chain analytics industry as a whole, which is what we like to call the new TA. And this is transaction analysis as opposed to technical analysis. So the previous kind of theme of the industry, prior to this sort of emergence of new on-chain information being used for trading, was technical analysis. It was looking at price action, looking at different graphs, and trying to understand whether an asset was going to go up or down based on its previous price performance. As we know, previous price performance is no indication of what an asset is likely to do in the future. And so instead, what we now have is something that's much more powerful, which is transaction analysis. And what we describe as transaction analysis is actually looking at the movements on chain of particular entities or other kinds of players within the cryptocurrency space to try to understand what they're investing in, what they're buying, what they're selling, and where. And whether those things are likely to have an impact on the market, whether they're likely to have an impact on news, and create volatility in any sense, whether it be up or down. This kind of transaction analysis has been super popularized, primarily by Arkham. And if you go on Twitter on any given day, you could look at all of this different kind of information and see, for example, whether on this particular day MicroStrategy or Michael Saylor are buying Bitcoin. And using that kind of information to determine whether or not you should yourself be allocating significantly more money into a particular asset. But it isn't just analyzing companies like MicroStrategy. We have managed to produce information about the largest market makers in the world, exchanges, the inflows and outflows from these different types of businesses. Another highly popularized type of entity to look at their transactions has been governments, looking at the United States government now, for example. One of the things that was discussed in one of the previous talks here was whether or not it was true that the United States government actually held 200,000 Bitcoin or some equivalent to that. How do you actually know that information? How can you audit the amount of Bitcoin or other kind of cryptocurrency that any of these entities have? Luckily, we've managed to create a platform that is able to do that in an automated manner, in a way where you can go on the Arkham Intelligence platform, you can search for the United States government, and you can see the full history of where they've gotten all of their Bitcoin from, when they acquired it, what the average cost basis was, did it come from potentially an arrest, coming from a darknet market where they seized all of that Bitcoin, or did it come from a different kind of source? And is it now being moved into a different place for example, a Bitcoin strategic reserve? And if you're looking at this information, that might be the kind of thing that could be market moving news, and therefore something that you can take advantage of as a trader. So looking at it from a historical perspective, sort of zooming out, we've been on the details of on-chain analytics and how exactly you can use it in order for your personal benefit. But where does this all come from and how has it evolved over time? The way we view this at Arkham is that trading and the information that emerges from trading has evolved throughout the centuries. A lot of the first forms of trading weren't even digital. This is a relatively new phenomenon. Previously, when people were trading in markets, for example, or bartering, as you see in the top left-hand corner, there's no information being produced about these trades. I could give you a gold coin in exchange for a sack of potatoes, and the only place where this information would be written would be if the merchant decided to, for example, produce a receipt, which only they saw or potentially I saw. All of this kind of commerce and all of these different merchants have then evolved into something a bit more sophisticated in the top right-hand corner, which is trading pits. So these are places where, in a centralized manner, in a market, information is being produced about what assets, in this case, securities or stocks, for example, have been bought and sold. And this used to be done in person. Prior to the internet, the place where you would actually go in order to acquire these different types of papers in exchange for money was in these sort of centralized trading pits. But now, as technology has progressed and the internet has evolved, it's all moved online. And so if you're buying or selling stocks, you can now do this from your computer, you can do this from your phone, and there are a variety of different internet brokerages where you can submit trades, send the money completely electronically, and there's a record being kept on your device, on the broker's device, and potentially by a regulator such as the SEC. But it's not viewable by anyone else, except in cases where there's a required regulatory filing, for example. If you're the owner of more than 10% of a publicly traded stock, you're required to submit a disclosure within, let's say, 90 days that you have taken that position. However, what we're seeing in the cryptocurrency space is something completely different. It's the first time in history where any trade and transaction that people have made across different wallets on a particular chain has been recorded and viewable and can be monitored by any other player across the globe. We're able to see all of these different assets, be it Bitcoin, Solana, Ethereum, or any other number of assets, We can see in real time who the largest holders are, when they buy these assets, when they sell these assets, and their pattern and behaviors from across the globe at any point in time. And this is something that has never existed before. So how much has it actually taken off? How much traction has happened within the on-chain analytics ecosystem? Just within the Arkham community alone, we have managed to find a number of different people who are interested in what our technology is producing. That has gone incredibly viral online. This is all culminated in something like 6.5 million registered users for the Arkham Intelligence platform, 2.5 million people coming to our site every month, millions more, of course, being able to benefit from our technology and from the information on our platform online, for example, on Twitter. That number is a bit more opaque and significantly much larger. And something like 2,000 Arkham VIPs who are dedicated to our community exclusively within on-chain analytics. So where to next? Where do we go for Arkham now that we've managed to create an on-chain analytics platform that's being used by millions of different people and primarily traders? Our next step as a business has been to grow the Arkham Exchange, a place where rather than looking at analytics and what's going on in the market and switching from our website to another place to actually trade, you can do it all in a single place. So this means having a transparent website where people are able to do the thing that people do the most within the cryptocurrency ecosystem, which is trade spot and derivative tokens, via a central limit order book, and trading a variety of different products such as spot and perpetuals. We offer this to a number of different retail and institutional customers, and we're super proud to have launched in certain states within the US. Now, what's cool about this is we actually offer one of the only platforms where, in real time, people are able to go onto the Arkham Intelligence platform and see our proof of funds and proof of reserves in real time. Everything that is being held on the Arkham Exchange is viewable within our platform in terms of the different assets that users are depositing and withdrawing, where they're going, where they're coming from. And this is something that even some of the largest and most trusted exchanges in the world don't offer. In order to actually understand, where your money is, it requires something like a third-party audit or going through different kinds of public filings from third-party auditors to try to understand where is my Bitcoin. And this is on top of a number of other awesome features that we've managed to promote via the Arkham Exchange. And this all comes to culminate into an integrated trading and intelligence platform, using on-chain analytics in order to determine what trades you actually want to place, and then having a single website and UI where you can do that all in a single place. Looking at top holders, filtering transactions, visualizing different blockchain networks and the largest traders on them, and then immediately clicking on that particular asset within Arkham and placing your own trades. This all culminates into our vision from world historical information, where we were in the past to where we are now, to delivering all of this intelligence and analytics, spot and derivatives trading, as well as news and research, all in a single platform. Thank you all very much, and you can find us on arkham.com.
Please welcome James Seyffert, Robbie Mitchnick, and Zhang Bui.
Hi, everyone. All right, I'm James Seyffert. I am an ETF research analyst, and I cover pretty much anything that does the overlap between DeFi, crypto, and TradFi, primarily in the asset management industry. Joining me is Zhang Bui. She's head of US equities and ETFs at NASDAQ. And Robbie Mitchnick, who's already been on stage. But if you don't know, he's managing director and head of digital assets at BlackRock. And though he'll dispute this title, he's colloquially known as the guy that orange-pilled Larry Fink. Larry Fink, the CEO of BlackRock. So, Robbie, let's just dive into what's going on in the markets right now. You guys have written some very strong pieces that you've said this publicly in interviews, you do not view Bitcoin as a risk asset. The market definitely does, based on the price action we've seen so far this year, particularly with the tailwind of positive headlines we've seen, particularly for Bitcoin and crypto more broadly. I guess, like, how do you view Bitcoin? What do you think it's going to take for the market to view it the same way that you and digital assets at BlackRock views it?
Yeah. Well, I think actually, James, a lot of Bitcoin investors view it as not this risk-on asset, as actually more like digital gold. But those investors trade a lot less than part of the community that is driving the price action that you've seen. I mean, it's one way to think about the Bitcoin market, right, is there's sort of two layers. There's a top layer that is less probably by assets, but they trade a lot, tend to be levered, quite speculative. They trade it up and down like tech equities, right? Then there's a bottom layer, which is actually much bigger. It trades a lot less. It's much more long-term fundamentals based, and I think overwhelmingly views it as digital gold. But on any given short-term basis, you can get predominance by that first group. Over the long term, I think we still believe in what it is, which is a global, scarce, decentralized asset that's not tied to any one country, political, economic, monetary system. There's a lot of appeal in that. And that asset doesn't care at all about tariffs. It's certainly not afraid of a recession. In fact, a recession is probably a big catalyst for Bitcoin. And of course, that's very counter to some of the short-term moves that you see. And for some, they may view that as irrational price action and actually see it as an opportunity.
So Saylor was just on stage, you called it digital gold. He was saying that he thinks Bitcoin should be worth as much, if not significantly more than gold, which would be a $20 trillion market cap. BlackRock has one of the largest gold ETFs in the world in IAU. Do you guys interact with them at all? Do you guys butt heads? The IBIT versus IAU conversation?
No, it's all one team. I think they're very happy for the success of IBIT. And, you know, there's a lot of, frankly, like-mindedness in investors who hold gold or hold IAU and in investors who hold Bitcoin, hold IBIT. They both view the value of a alternative monetary asset that exists outside of existing systems, that is scarce and fixed supply, that's decentralized in nature. And they are fearful, in a lot of cases, of the kinds of risks that many of those long-term fundamental buy and hold Bitcoin investors are fearful of, which is, you know, debt and deficit accumulation, money printing, inflation, currency debasement, geopolitical disorder, all things that you know, are on the horizon and the minds of a lot of investors today. Not all investors have made the link between the two, and the narratives that are out there, to your initial question around risk on, is very confusing and unhelpful to them, because they get the digital gold story, but then they look and they see people calling it risk on, and they're for some reason worried about the purchasing manufacturing index and tariffs and like job market slowdown, which of course has nothing to do with Bitcoin. And that just throws off the narrative and creates a lot of confusion, particularly for institutional investors who are looking at adopting it.
Great. Let's move on to more ETP-specific questions. So Zhang, a lot of people don't realize this. Everyone sees these filings that come out. People are trying to track what ETFs are going to launch. And a lot of people don't realize that it's the exchanges that technically file these rule change filings, known as 19B4s. I have like 40 of them that I'm tracking right now. Can you just talk about what you guys are seeing, what is coming down the pike for crypto-related ETPs as far as these rule change proposals, and like what that process actually looks like?
Yeah, so I mean, for an ETF to come to market, you know, issuers like BlackRock will file a registration statement with the SEC. You know, for these spot commodity-based products, they typically file a Form S-1 registration statement with the Division of Corporate Finance with the SEC. And for spot products, the exchanges don't have generic listing rules that would just allow us to be able to list them without needing to go back to the SEC. So in hence, what you're talking about is we have to file these 19B4 rule filings with the SEC Division of Trading and Markets to amend our rules to allow us to list and trade these products. We had to do them for Bitcoin and Ethereum. It's been a year, a little over a year since the approval of the first spot Bitcoin ETFs, 19B4s, in January of 2024. We partnered with BlackRock on launching those products, and you really see how much the ETF wrapper has performed well with Bitcoin or Ethereum within the wrapper. And I think time and time again, the ETF shows how resilient it is, how it's able to add liquidity to the underlying asset class, how it's able to democratize it and provide it access to a lot more investors into the asset class. So we saw that to be the case with Bitcoin and Ether. And then now, we do have filings out there for the additional set of coins. So we do have filings. We're working with issuers on, what's next. There's filings for XRP, for Litecoin, HBAR, and so forth. So I think from our conversations with issuers, I think there's really three main initiatives that issuers are looking to really advocate with the SEC, and we're working on behalf of them to really move the buck forward. One is those additional assets, like what's next. And then the second piece is multi-coin assets as well. So being able to offer multi-coin, like an index type of product. And then third is enhancing the existing product. So we have Bitcoin and Ether ETF approvals. Like how can we make it more efficient? So offering in-kind creation redemption, offering staking, and even the options on these ETFs. How can we make the liquidity ecosystem around them even better? So we do have filings in place that are looking to increase position limits on IBIT options. We're also looking to be able to offer more flexible options contracts on IBIT options. So there's a lot of different initiatives to really help really make these investment vehicles even more attractive.
So let's stay on the topic. I want to get to some of the altcoin stuff in a minute, but Robbie, one of the things that's filed is to do in-kind creation redemptions. NASDAQ and BlackRock fought pretty hard in November and December of 2023 for the initial approvals to allow for in-kind creation redemption, which would mean in Bitcoin, you would, in a creation of shares of ETFs, you'd hand over the Bitcoin, in return you get the shares of the ETF, or vice versa. They made it go in cash instead of in kind. We're pretty optimistic that this SEC is going to approve these things for in-kind. So I have two questions for you, Robbie. One, what is the benefit of in-kind? And two, the number one question I get from people about this is a lot of people think, like me as a retail investor, if I have thousands of dollars or a couple $100,000 of a Bitcoin or Bitcoin ETF, I'll be able to change it. But will individuals be able to do it, or is it only for the institutions that can make markets in ETFs?
Sure. So we'll start with the first one. The benefits of in-kind, there are a couple. First, it's more efficient, right? And actually, the way we've gotten the cash trading model in these products has gotten to actually quite an efficient place. But in-kind gets you even to another level, which is, if you think about it today in very simple terms, when you have a creation order or redemption order from an AP on an ETF, there is a settlement of cash against ETF shares today, and there's a separate settlement of cash against Bitcoin today. In an in-kind model, you cut out the cash elements of that, and so you collapse the trade down to a settlement of Bitcoin in exchange for shares. That's more efficient. It also should, over time, and some of this is regulatory dependent, make it cheaper for market makers and APs to create and redeem. And that ultimately redounds to the benefit of investors, because if the transaction costs to create and redeem in and out of the fund are lower, then ultimately it'll trade even tighter to the true net asset value, which it already trades quite tight today, but potentially even tighter over time. So the second part of the benefit is for investors who, and this gets to your second question, for investors who have relationships with the authorized participants who create and redeem shares in these funds, which is typically banks and large market-making firms, then there's the ability to actually move Bitcoin in and take Bitcoin out without having to sell back and forth and buy back in cash. And so that is exciting to lots of investors who today would like to maybe diversify some of their existing large physical Bitcoin positions, holding some of it through the ETF wrapper, and so we're optimistic that that'll get done at some point, in the next little bit.
Great. Let's move on. The question I want to ask you is like what filing in the crypto space is coming next for BlackRock, but I know you're not going to answer that question. You guys haven't filed for an index ETF. You haven't filed for anything other than Bitcoin or Ethereum. So what I will ask is, what do you need to see from other projects, other coins, other layer 1s or layer 2s before you would consider offering or filing for an ETF that would hold those?
Yeah, so I think first and foremost, we're very focused on the client dynamic and understanding where real client demand exists for efficient turnkey access vehicles in the same way that it absolutely did for Bitcoin and also did for Ether. And so that's the number one guiding thing. When it comes to things that are maybe a little less straightforward than just these single ticker products, there's an element of getting comfort and building conviction in the idea that we can build something that's actually efficient and a great product for investors. Not just that investors might buy it, but to actually understand that this is solving a problem for them and is in a structure that benefits them. And that is not so easy to do for a lot of these things, and that's part of the ongoing sort of monitoring plus exploration evaluation process that we undertake.
Got it. Zhang, can you just talk a little bit about the process that you guys are both involved in this process and going back and forth with the SEC. You both fought hard to allow for Bitcoin and Ethereum. I'm just here, a lot of people are curious to know like what's happening behind closed doors, and you're probably not going to give us everything. Yeah. A lot of people are curious to hear like how are things different from the prior administration to now, and just broadly speaking, what are those conversations like with the SEC? Has the tone? It's very obvious from anyone who's not in those meetings that the tone has shifted with all these lawsuits that have dropped, with the approvals that are happening left and right for different things. Can you just talk us through that relationship that you guys have and the conversations you have with the SEC? What are they questioning right now with these filings that you just spoke about?
Yeah, I mean, as an exchange, we have a really good working relationship with the commission, across various different administrations. I think, last year we were able to have milestone approvals for 19B4s, and we worked very closely between BlackRock, ourselves, other issuers, and the SEC to address a lot of those concerns, and how we got the initial products to market, and easing, with these filings, like the utmost concern for us is how to prevent fraud and manipulation. Like at the core for us, we care about transparency, integrity, and resiliency. So like every time we're working on a filing, like that's what we care about, that's what we advocate for, and those are the justifications we have when we bring these products to market. And so, I mean, with the crypto task force and the latest administration, we're engaging with them, a lot in terms of on our live filings and working through with them on, what are they evaluating when it comes to these next sets of filings. But also as a whole, like I think it's been really encouraging to see the commission engage the public, Commissioner Peirce has put out a series of questions and requests for information about how the commission should evaluate these next sets of ETFs, like knowing that the prior administrations have really thought a lot, looked to consider surveillance sharing agreements between the exchanges and the underlying spot market as a way to prevent fraud and manipulation. So they're looking at ways like what are other ways to prevent fraud and manipulation in the ETF wrapper, and like what are different characteristics of the underlying assets or the reference rate benchmark that really makes the price resilient and to manipulation that way. And so we're really encouraged by that level of engagement from the commission, and we're looking forward to developing that framework to evaluate all various different kinds of coins and having that clarity to the issuer and to the street of what's permissible in an ETF wrapper.
Sticking with this conversation, we just had CME futures on Solana list earlier this week. We had CFTC regulated futures also on Coinbase already before that. Today, I believe we had some Solana futures ETFs list on NASDAQ.
Yes.
Seems very fast to me, considering what we had to go through for the Bitcoin futures and the Ethereum futures ETFs. Can you just talk about that listing process and what's going on there?
Yeah, it's definitely an exciting day to be on this panel and have the next set of digital assets products be launched. So as you said, there is two Solana ETFs launched today, for 1x Solana futures as well as 2x Solana futures. And as you saw it with Bitcoin and Ether before, the futures-based products were able to get through the SEC review process much quicker. I think different than what I described before about the issuer needing to file registration statement of S1 with corporate finance, and then us needing to amend our rules to allow us to list for these future-based products actually fit the guidelines of the Investment Company Act of 1940. I know I'm going way into the weeds on all of these things, so just bear with me, but there's a lot of that already pre-work that has been done, and exchanges actually have generic listing standards that allows us that if the SEC lights these products, we can list them very quickly. So the issuer for these Solana products, knowing that the future was being listed fairly imminently, they had filed for these products 2 months ago in anticipation of all this work to be done, and they've worked with the ecosystem and their trading partners to be able to support them, and then our listing rules were ready to support them going forward. So they've really been able to capitalize on a lot of the movement in terms of like what are the futures exchanges doing, and then working with the commission already in the background to be able to get their green light for their 40 Act-based product.
Yeah, these 40 Act products that hold futures, there's a whole bunch of those filed for XRP and other coins as well. Those could be potentially coming live in the next month or two on other exchanges, including NASDAQ. But the real demand tends to be in spot asset ETFs. These futures ETFs are more used as trading vehicles rather than the long-term buy and hold. But it's still very interesting to see because as we saw with Bitcoin and Ethereum, if you get a futures product, you're pretty likely to get a spot product at some point in the future. Robbie, let's go back to Bitcoin a bit. You made, not you specifically, but BlackRock made a bunch of headlines. Model portfolios, for those that don't know what that is, it's essentially like BlackRock has these free recipes that they'll hand out to advisors or anyone who wants to follow them for how to create a portfolio of a bunch of ETFs or assets, what have you. And there's literally trillions of dollars, or at least hundreds of billions, tracking these things. BlackRock is known as a model portfolio provider. A subset of their models added Bitcoin as a 1% to 2% allocation very recently. Can you talk about what those models are and what that conversation was like before you guys actually decided to add Bitcoin? Because it's kind of like it's very controversial in many circles. So I'm curious to see like what the discussion was about, like, do we want to add it? Don't we want to add it?
Yeah.
And the weighting, obviously.
So the particular model in question is called target allocation with alts. So it's one part of our models franchise. And in that model, there is a decent sized allocation to alts. And within that alt sleeve now, there's a 1% to 2% allocation to Bitcoin. That process is many years long, frankly, and reflects some of the fundamental analysis and thinking around risk return, portfolio impact, et cetera, that you've seen come out in other papers that we've published and also in commentaries that folks from BlackRock have done. And part of it is the potential for Bitcoin to serve a role as a unique diversifier because of its properties that we discussed off the top, and potentially a hedge against some of the left tail risks that exist in a portfolio. And I think it's a really interesting dynamic because this question of what it's going to be and how broadly it's going to be adopted by institutions and will it be in model portfolios. And James, I think that a lot of the crypto ecosystem does not grasp the significance of this point, which is if this is a low or even negative correlation asset, it will be a staple of portfolios of all kinds all over the world in an institutional wealth advisory standpoint. If it is, in fact, levered beta trades like NASDAQ, which some days it does, even though that sort of belies the fundamentals in our view, then it's just another technology investment for most of those people. You can invest in it if you like it, you can skip it if you don't, right? That's really the significance of this debate of whether it's risk on or it's not risk on and what the correlation is. And I think that flies under the radar for a lot of crypto native folks in terms of just how meaningful it is.
Yeah, there's been over its history, Bitcoin has been pretty uncorrelated, if not negatively correlated. But recently it has been correlated to NASDAQ 100 tech stocks. You talked about institutional adoption. I've been on a few stages with you over the last year since you guys launched. What's going on with advisor adoption? I'm hearing a lot of rumors. Actually, they're not rumors. I know for a fact there are wealth platforms that are finally turning these things on. So there's two ways to basically, if you are running a wirehouse or a platform, it's either solicited or unsolicited. Basically, if you're the customer and you go to your advisor and you request to buy it, that could theoretically be approved. But most places had not yet got to the point where me as an advisor, I could recommend it in a portfolio. And that seems to be being turned on now, particularly with IBIT. Can you tell me like what those conversations are like? How often are you conversing with these teams that are deciding what can go on to these platforms? Where are we, like what inning are we in the term of advisor adoption?
Right. So I can tell you that one group that's not focused on short-term price movements is that audience in terms of the home offices that actually run these wealth advisory platforms. Those conversations started in January of 2024. And I would say that the pace of them is probably higher in the first quarter of 2025, despite a less compelling price trading pattern than it's been at any point since these ETFs launched. There are a couple big names that are known, Morgan Stanley amongst them. There are a number of others that are progressing quite well through their process. It's a long diligence, education, research process for them. Basically, every major firm is at some stage of that journey, but that takes a much longer term view, and I think the momentum there is quite good.
Yeah, you said negative price action. I feel like some of the people I talk to, like the fact that the price is back down is kind of like turned them on to like accelerate even more because they want to be able to allocate in a potential dip. Is anecdotally from the people I'm speaking to.
It's funny because I had one institutional client conversation recently, and they bought a decent sized position, but they want it to be much larger. But this was back when it was 100K, and they said, well, but I wanted to have a 30% pullback, and then I'm gonna do it. And I don't know whether that's the right strategy or not, but it's interesting because it's very counter to what a lot of the investor base in crypto has been historically, which is the opposite, right? It goes up more, I buy more, it goes down, I flee for the exits, right? And that's really healthy for the long-term fundamentals of this market, that you have more investors who are in that opposite direction for many reasons, but including dampening volatility, right? If you have buyers when things move down instead of all one-directional trading.
Let's go to you, Zhang. NASDAQ and other exchanges, they have made a lot of noise because specifically NASDAQ, you're publicly saying you're going to move to 24/5 trading, so 24 hours a day, 5 days a week. I mean, potentially, I assume you'll get to some point maybe 24/7. How much of that is driven by this industry and Bitcoin and other digital assets trading 24/7? How much of it is just normal course of where you guys were going anyway? And what's the driving factor? When is it going to happen? Anything you can share there?
Yeah, I mean, we definitely see that this is where the markets are moving to the 24-hour trade or continuous trading. There's a lot of demand globally for U.S. stocks, and people want to trade within their the hours that they're typically awake. And I think a lot of it is, like you said, because people are used to trading crypto 24/7. They're able to make place trades and have high conviction over the weekend and have a way to express their views of the market that way. So we're hearing it across the board from global broker dealers, clients who they're servicing, even within the U.S. Like there's a number of U.S. brokers that already are offering overnight trading because their customers are used to trading crypto in those hours. So as that we saw that that's the trend, we want to ensure that NASDAQ supports that, given that we are a significant listing venue, a significant trading venue, that we want to support that trend. I mean, there's still a lot of operational things that needs to be worked out. I think a little bit different from crypto, from a corporate action standpoint, announcements, so there's some consideration when it comes to equities that we were really being mindful of, and we were engaging the industry in resolving those.
Great. We're running out of time, but quickly, as somebody who works at a firm where, as I said, Bitcoin and crypto, it's like a lightning rod. People are usually very in favor or very against. There's very few people that are like neutral in the middle. That's the same case at Bloomberg. I'm betting it's the same case at BlackRock. I mean, Larry Fink was on the complete opposite side of where he is now on Bitcoin. What is the conversations like internally with you at BlackRock? We'll start with Robbie, and then I also want to hear NASDAQ, because obviously this is, again, like I said, very controversial asset. What are those conversations like with people who are on the opposite side of the view as you?
Well, there's a ton of energy around it. I would say there's not a lot of folks who are, you know, naysayers in a fundamental sense at this point. More of the debate is around like just how does it fit in a portfolio and what is the right sizing, what is the right way to think about risk, right? It's not about whether this is worth spending time on. I think everyone at the firm now has high conviction that it is.
Yeah, and Robbie wrote a paper not too long ago basically saying that on a risk-weighted based approach, it makes sense as something like a 2% allocation into a global portfolio, which kind of makes sense with the fact that the model portfolio that BlackRock has put in 1.5%. But were those related at all? Were those decisions related?
Well, there's lots of consultation and discussion across the various parts of the firm. So slightly different processes, but lots of integration of the way those conclusions ultimately get made.
Zhang, how about you? NASDAQ has been very pro-tech, very pro-digital assets for the most part. What's it like at NASDAQ?
Yeah, I mean, like you said, like we've always been very forward with innovative technology and really be able, and so crypto and digital assets is definitely not like similar in that way. Like as Robbie said, across the company, we're very supportive of it and looks for ways to like really drive innovation in the space. And we work with ETF issuers and engage regulators to really try to create that framework around how can we be greater partners to the ecosystem. I think from our concern, it's always about investor protection and transparency. So as we try to create that framework, that's what's on the back of our mind.
Last question, quick answer. I mean, today we saw a filing for Canary Pengu ETF. There's filings for Melania coin ETFs and Trump coin ETFs. Where do you guys draw the line and where you'll go to bat with the SEC for an issuer? Is there a line that you guys are drawing in the sand?
Yeah, I mean, we're very focused on how do you create smart regulation and how do you promote innovation while being thoughtful about investor protection and the right disclosures that are out there. So we're working with the commission on like that to get clarity, like what's available, like how do they see what's the security, what's not, and how does that fit within our listing framework?
Yeah, we should get those answers this year, hopefully, if not, definitely next year from Congress or from the SEC and CFTC. All right, everyone, that's all we have time for. Thank you very much.
Thank you.
Please welcome back Jason Yanowitz.
We've got round two from the president. No, I'm kidding. That's it for the main stage. I just want to say thank you to everybody. We have lunch right now. We've got the afternoon tracks coming up after that. We have 2 more events later this year. There's Permissionless in Brooklyn, our crypto native event, a little more focused on the developers and the founders. That's June 24th through 26th in Brooklyn. And then we've got DAS London, same event, just for the London crowd. That's October 13th through 15th. So Blockworks has like 20, 30, 40 folks here. So if you guys want to attend those, you can buy tickets online. If you want to sponsor, let us know. We'll help you out. So yeah, thank you all for coming out. Really excited about this, and see you in the afternoon tracks.
you.